So everybody can see my screen?
Yes, boss.
Okay. So thank you very much. Let us start today. Today is the last module of the ACCA's designed course on UAE corporate tax, UAE tax and regulation, not corporate tax, tax and regulation, because it contains corporate tax as well as VAT and a lot of other corporate laws as well. In this module number 14, titled as Special Entities, what we are going to read or study today is review of the implications arising from the corporate tax decree law for special entities, certain principles that have been laid down in the mother law of corporate tax, such as deductions, limitations, etc. And we'll be able to determine the basis of corporate taxation available to special entities such as banks, etc., trusts. We will have a detailed look at it. So we start off from financial institutions. Now, let us go through this. Liability to corporate taxation. A UAE resident juridical person carrying on financial institution business is a taxable person. So, Mr. Nauzar, what in your view should be considered as a financial institution? Mr. Nauzar, are you muted? Oh, I don't know. It seems Mr. Nauzar is not connected right now, but anyways. Probably he'll connect. Anybody else wishes to answer this? How would you, what would you call a financial institution? If you need to decide what is a financial institution, what will be the reference point? Abbas, what would you say to that? So, guys, there are different frameworks here in UAE. One is the mainland framework, and then there is free zone framework. So, in the mainland framework, financial institutions such as banks, finance houses, etc., they are all referred to in the central bank regulations. So, UAE central bank has a set of prudential regulations. That's where we can find a reference to it. Then two of the biggest, financial free zones. Two of the biggest financial free zones, which is DIFC, Dubai International Financial Center, as well as ADGM, which is Abu Dhabi Global Markets. You can find the various types of financial institutions there as well. So that is the answer if you come across this question, and even in practice also. So there are certain provisions we are going to have a look at it going forward. So if the first point that it is mentioning, UAE resident juridical person carrying on a financial institution business is a taxable person, so there is no exception to it. Corporation established outside the UAE, which is a non-resident company, can have a branch, right? Carrying on business in the UAE as a through a permanent establishment, which is addressed in Article 14, if you recall. And I think we should by now remember the concept or definition of what exactly is a permanent establishment. Would any one of the participants care to tell me how would you define, or how would you say, what would you say is an example of a permanent establishment of a for non-resident company operating in UAE? What would you say is a permanent establishment? Anyone? By now you should know this. We've addressed it quite a few times. Yeah, Mr. Nazar, what would you call a permanent establishment?
This is this is an step the place where you conduct your ordinary business,
So fixed.
either office or the factory or workshop or
Very
whatever.
good. Very
And
good.
yeah.
So broadly speaking, if we have to define in very few words, less than a sentence, then it would be a fixed place of business. Generally speaking, a fixed place of business. From a legal structure perspective, what is the biggest type of permanent establishment, Mr. Nozer, that you would find in any country for that matter, including UAE?
The limited liability companies.
No, that's I couldn't understand, but you mentioned company. The answer is branches. So from a legal structure perspective, branch is the best example of a permanent establishment. Why? Because branch in itself does not have a legal entity of its own. It is an extension of the mother company. And because we are talking about branch of a foreign entity, branch of a non-resident entity, so that originally that company is located in another country, India, Pakistan, USA, China, whatever, and that branch is operating in UAE. So if you really think about it, actually, if that branch enters into a contract with any person or party, it's not really that branch that is entering into that contract. It is that mother company that is entering into that contract. Why? Because branch is only an extension of the original company. Okay. So, anyways, uh, in the same sentence, you're going to find another very important aspect as well. We just addressed corporation established outside UAE and carrying on business through either a permanent establishment, which is Article 14, deriving UAE source income. Now, there is another article, Article 13, uh, or which has a nexus in the UAE as specified in a decision. So, Mr. Nozer, UAE sourced income can be earned through a branch, but or through a permanent establishment. But can UAE sourced income be earned uh, without a permanent establishment as well?
Yes, yes.
What could be the example?
The something dividend income,
Hmm. Dividend income is very one example, very right. Interest could be another example.
interest, yes, interest.
Interest on loan, or for that matter, artists who come and perform, or players, athletes, etc., who just come for one tournament or one one-off match. So they could earn UAE sourced income without having a permanent establishment. These are some examples, right? It's there is another word used, nexus. What would that be?
Nexus mean you are having any
Your voice is breaking.
properties or anything in the country.
Your voice broke,
No,
boss.
you having are you having any properties or anything
Hmm.
in the country?
Okay, this is from a UAE perspective. Your answer is correct. Nexus means actually it has been specified in a decision that the only example of nexus in UAE is actually an immovable property where which is giving rise to income. But on a global level, nexus has a larger meaning or larger definition. Can you recall the literal meaning of the word nexus? Nexus is actually the literal meaning, dictionary meaning of the word nexus means a series or connection of, uh, network of connections, etc. For example, a digital nexus is a great example to understand or for example, someone sitting in China and earning digital income because of their YouTube channel, which is aimed at the UAE audience, for example. That's an example of a nexus because quite a few people are there on one channel on YouTube or Instagram, etc. And this is so it's a type of a permanent establishment. The only difference is it is digital, right? So nexus can be any series or connections. Okay, but in UAE actually. The only example of nexus that has been provided in a decision is the immovable property, which you rightly answered, which has a nexus in UAE specified in a decision, will also be liable to UAE corporate taxation. So that also you correctly mentioned. Yes, you want to say something?
Just just on this nexus part. So if let's say, and I'm not talking about the UAE definition, but like a like a broader definition.
Hmm.
So if let's say, you have these foreign bodies, like for example, like I don't know, maybe I don't know, World Economic Forum, right? They let's say do some event in the UAE,
Hmm.
and let's say they're also earning any income from that. So would that also
Absolutely,
be sort of
yes, yes,
part of
absolutely.
that?
For example, I'm part of a nexus which is called. I mean, I'm using the word nexus from corporate tax perspective. I'm part of an international organization which is called BNI, Business Network International. Okay, so BNI, every Friday morning we hold physical meetings, but BNI has hybrid chapters as well, which means people can join a BNI chapter in UAE through online meetings as well, and that's a very disciplined structured organization. Every Friday or every particular day of the week they will hold meetings and they can get business referrals from the network members. That's a great example of nexus. BNI, do study that. You will find that the model that BNI has, bni.com, also you can look. That's a great example of a digital nexus for entity. Very rightly pointed out, Abbas. Thank you for this value addition.
Okay, thank you.
Okay. So, anyways, going forward, a foreign financial institutions UAE branch, foreign financial institutions UAE branch may also be liable to emirate level tax on the profits of that branch, but those taxes are levied at emirate level, not at federal level. So, by now, I think most of us know that there are different hierarchies of legislation or lawmaking and autonomy. So the top level is the federal level, and after that there is emirate level. Actually, even before promulgation of UAE corporate tax law, two sectors were already subject to corporate or business taxation. So, Mr. Nozer, can you answer this question? Which two sectors were already subject to business taxation in UAE, even before UAE corporate tax law came into force? They were already, paying tax, business tax. Which two
Oil,
sectors?
oil and the financial
Only,
oil,
only
oil and
financial?
the foreign banks. Oil
Ha,
sector,
correct.
oil
Very good.
and gas and the foreign
Very
banks.
good. Correct answer. Yes. So it was oil and gas sector, and they were subject to emirate level taxation already before even corporate tax was launched in UAE. And the other sector was banks, foreign banks. So with a,
So, I'm sorry. I'm
yeah,
sorry. Just I'm sorry.
yeah,
So,
yeah.
is this the reason that they have been excluded from corporate tax, like in the exemptions, if I'm not wrong? Um,
Unfortunately, the banking sector is facing a lot of issue because of this. Oil and gas sector,
yeah, oil and gas. I mean,
oil and gas were excluded. Yes, why? Because there is more to what seems. Abbas, let's put it that way. They were oil and gas sector around the world, particularly the OPEC nations. They, you know about the operator and non-operator model, right? One is
mm,
an operator, the other ones are non-operators in exploration and production. Usually it is done by way of consortium. So multiple large-sized, oil and gas companies, they form a consortium or joint venture or concession, and they operate, right? So this oil and gas exploration and extraction is subject to very heavy taxation, up to 55% or 45%. This much amount of the oil revenue is paid to the government as tax. Okay, and the during the formation of UAE, you know that I'm talking about even before 1971, which is the year UAE was formed. This matter was probably discussed even at that time as well, and or later whenever oil started getting discovered, and this matter was raised, and Emirates, because you remember UAE has a supreme council, right? which is
yes,
which includes all the rulers of the seven emirates. So
Emirates.
So, as a way of a national matter of national importance, the Supreme Council basically agreed that because oil and gas is such a critical economic resource that they wanted to keep it under the control of the emirate itself. So United Arab Emirates is basically a union of previously independent sovereign states. So all those emirates joined together, so they still have kind of an equal right in the running of the country or the federation. So, as a decision of the Supreme Council, the taxation of oil and gas was kept at emirate level. This authority was not, given to federation. That's why, and it is very heavy. So, double taxation would result in very difficult situation.
Yeah.
There's a lot of political angle involved in it. So,
Okay.
anyways, but financial institution on the other hand, they are facing a lot of trouble. Why? Because of corporate taxation, there is a kind of a double taxation that they have to face
Yeah.
at domestic level. They have to pay emirate level taxation, and then they have to pay the federal level tax as well. So that's a bit of a pickle for them. With a non-resident financial institution potentially liable to the emirate level corporate taxation as well as the UAE, federal level corporate taxation. Question is whether the double taxation exists without a cabinet decision clarifying the position to the contrary or an amendment. So that's what I just said. They are the question. We know the answer to this question actually.
Yeah.
There is double taxation, but I think it may be addressed at a later stage going forward. We'll see about that. But again, even financial services sector is also it is a very heavy question. Any decision that would come that would address this problem for the financial institutions, it is a very difficult question. If you guys know about the UAE economy, just Google it. You will find that the biggest sector, the probably the other than the oil, the biggest revenue generating sector or the largest entities from any sector operating in UAE are the banks. So that is why, as I said earlier, these decisions of imposing taxation, they carry a heavy political weight as well. So, anyways, coming on the non-resident financial institutions deductibility for corporate tax purposes, emirate level corporate taxation is incorporated in Section 4. Now, quick question: what is Section 4 about? Abbas, you should not answer. Anybody else?
Exempt income, no?
Exempt income. Yes, correct. Exempt income.
Exempt person, sorry, exempt person.
That is the correct answer. Exempt person, not exempt
Sorry.
income.
Okay.
So these
Okay,
are
exempt
uh,
income is another section, something.
correct, correct.
Yes, yes.
Later on. So, as I mentioned earlier, the UAE corporate tax law is designed in a way that we start by asking the question, is this person a specifically exempted person? So, there are quite a few types of persons that have been granted exemption. So, that's the first view on any person's corporate tax impact assessment. So, anyways, Article 4 is for that. Commentary on non-resident financial institutions deductibility we will see. So this is a little bit of a quick recap. So we are going to quickly go through this. Both non-resident financial institutions as well as resident financial institutions shall be subject to corporate taxation and under the normal tax regime. What is that normal tax regime? First 375K 0%, and above that 9%, right? So there is a cabinet decision 116 of 2022 on annual taxable income subject to corporate tax. This is, I'm not sure if it is 2022. It should be 2023 actually. But anyways, on annual taxable income subject to corporate tax, while Article 3(1)(b), you guys remember what is the purpose of Article 3 in the corporate tax law?
Tax rates, no?
Tax rights.
No,
Oh,
no.
rates.
Rates,
Ah,
yes.
tax rates. Acha. Oh, okay. You said rates actually. I heard right. But anyways, yes, correct answer. So, Article 3 There is clause 1 and then clause 2 as well, and now we have clause 3 as well. I think you guys would remember this point. Later on, third regime was also introduced. So it says that 9% will be above 375K, where the financial institution is to be a qualifying free zone person, which is under Article 18. Can you guys think of a situation where a financial institution can be a qualifying free zone person? This question Abbas can answer. Difficult, right? So answer lies in MD, Ministerial Decision number 265. There, the types of businesses have been specified which can earn qualifying income or which can go for the qualifying free zone person status. Banking is specifically excluded activity, by the way. Okay, however, certain other types of financial institutions, they could gain this advantage. We can perhaps it will come at a later stage, but we will see about that. Uh, Okay, so where was I? Would be liable to tax at 0%. So if a financial institution becomes a qualifying free zone person, it would be taxed at 0%. Why? Because of the qualifying income. While the non-qualifying income would be liable to corporate tax at 9% rate. Uh, how many of you are appearing in the this session of this ACCA's exam? Mr. Nauzer is joining. Anyone else? Abbas, are you taking this?
No, I'm not taking the
You're not.
exam.
Okay, so it's only Mr. Nauzer who will be taking the exam. I think British Council, right, Mr. Nauzer?
Yes, a British Council, yes.
British Council. Okay. So, anyways, the reason I asked this question was, uh, uh, so Mr. Nauzer, for a
Yes,
qualifying free zone person, the qualifying income is taxed at the rate of 0%, correct?
yes, yes.
What about the non-qualifying income? Is it tax? Is there 375K threshold available for that? Zero rating threshold of 375K for non-qualifying income?
Yes, yes,
Yeah.
yes.
Abbas, what would you say?
I think it should be available for them.
Both are wrong. The for non-qualifying income, I specific on purpose asked this question because this is a common mistake everyone does. For a qualifying free zone person, the that part of income which is qualifying income is taxed at the rate of 0%, but non-qualifying income is taxed at a flat rate of 9%. There is no 375K zero rating threshold. Clear, guys?
Yes.
Yeah.
Yeah, okay. Cabinet decision number 55 of 2023 on determining qualifying income for the qualifying free zone person. This is the decision which clarifies the concept or the meaning of qualifying income. But then there is another decision, Ministerial Decision 265 of 2023, that specifies the different types of qualifying free zone persons or of those entities which can earn qualifying income. That was tax rates, and then again, quick recap: taxable income in the same manner as that which is applicable to non-financial institutions. The financial institutions' taxable income is calculated under Article 20. So, if you read Article 20, the name itself is taxable income. So, in that Article 20, quite a few provisions are provided, permits a taxable person to adjust its profits by substituting realized gains and losses for unrealized gains and losses were the financial institutions to elect to do so. This is a choice that has been provided in Article 20, whereby not only financial institution, any organization can choose to tax its capital gains on a realization basis rather than unrealized capital gain. Details will follow. To to elect to providing its accounting profits was calculated on accrual basis, and it's satisfied any conditions imposed by the minister as a precondition. At the date, no decision was made, but later on the clarifications have come. But the wordings in that Article 20 for the unrealized gains and losses, they have provided two choices for that. Meaning, what is the point we are discussing? The biggest implication, I would say, not only banks but insurance companies as well. Why? Because the entire income of an insurance company, other than the premiums, is in their investments. They do a lot of investments as well, right? So there is a lot of mark to market adjustments coming there, right? And majority of those gains, mark to market adjustments, are accrual basis. They are not actually realized in cash upon the closing of the financial statements, right? So there is a choice. So those financial institutions, those entities, I would say, financial institution is limiting limiting the interpretation, because any entity can achieve, adopt this choice. So what they can choose is either of the two. All assets and liabilities subject to fair value or impairment accounting. Any asset or liability which can be subject to fair value accounting or impairment accounting. That's one thing. They can entities can choose to tax or include their taxable gains, or for that matter losses, related to all assets or liabilities which are subject to fair value accounting or impairment accounting.
You mean
That's
that to include the unrealized gain and losses, huh?
no, on the contrary, to exclude unrealized gains and losses, because they have not been converted into cash yet. So you can make this
Okay.
choice, but then you will have to follow this choice consistently from year to year. It cannot happen that one year you choose, cash basis, next year you choose accrual basis, right?
Okay.
It has to be.
That mean this mean that like a cash base, cash basis accounting, tax
Yeah,
for the cash basis.
to no no to the extent of unrealized gains and losses, not the
Ah,
entire
it's not.
not the entire financial
It's not. It's not entire
uh,
other
other
the
things.
normal business income will go under accrual basis. This one only this part will go
Cash
under the
basis.
cash basis. Only
Correct.
this part means on the realization on
uh,
fixed asset and other things.
yes, correct, non-current assets, yes. So that this is one choice that you have. Or the other choice is that all assets and liabilities will not be considered. Only those assets and liabilities will be considered which are held on capital account. So capital nature liabilities what could be capital nature liabilities? Non-current liabilities, for example, right? You took a loan by issuing a debt instrument in the open market. So that could be a capital nature liability. Similarly, there will be capital nature assets as well. Okay, for example, investment property, right? So you record those in the investment property using the fair value model. What do you do, Mr. Nozer? You record all the gain and loss to the income for the year. It doesn't go to OCI, other comprehensive income. It is reported as part of the profits. Yeah, investment properties. But that there you can choose not to do that. You can choose
Mm.
only to consider cash basis accounting for that. But the keywords are held on capital account. Clear?
Okay. Yes. Yes. Yes.
Okay.
It's
There's
it's
an
not for
example.
resale. It's not for resale.
Yeah. So let's read an example. Assume the financial institution's accounting profit for 2025 tax period was 10 million dirhams, but included in that profit was 3.75 million dirhams worth of unrealized foreign exchange gain. The financial institution could elect to be taxed on the currency gain on a realization basis, resulting in it having an adjusted taxable income. So we will remove this much amount from 10 million total taxable income. You get my point? Because this was an unrealized gain. So you can remove it. So it will be taxed when it is actually realized. So the taxable income will drop to 6 million 250,000 dirhams. Clear?
Yes. Not only for the gain, even for the losses also we are doing the
Even yes,
same
even
treatment.
yeah, if you make a choice, na, then you cannot revoke it. Because then in that case, whether it is a gain or a loss, you have to do it. You have to follow it.
You need to You need to elect for that, or it's given automatically to the,
You have to
or you
elect.
need to
It's a
apply for.
yeah. You
You need
have
to
to
apply for
elect.
that.
You have to elect. You have to apply. Yes. So
Okay,
in
you
your
can apply.
corporate tax return, there is an adjustment column. So in that adjustment, you will need to do this. Okay. Now we're coming to the building on this discussion, what you just read, building on this discussion, we're coming to the topic of impairment and fair value. So let us go through this. What does fair value or impairment accounting mean to begin with? Impairment and fair value is an accounting method based on measuring the value of assets using the current prices and assets or liabilities. The value can change over time. So, just to let you guys know, recently myself and my team, I don't know if Kalima has joined or not, but Kalima was part of the team, and there is another girl as well, Ramsha. So, what we did was we did an engagement without disclosing the client name or the type, where we had to kind of change the basis of accounting from historical cost accounting to current value accounting. If you read the conceptual framework to the IFRS, if you open the book of IFRS, you will find at the beginning of that book a very detailed section called conceptual framework to the International Financial Reporting Standards. In that conceptual framework, in paragraph 6, I believe, 6.4, I think, first they have addressed what is historical cost convention or historical cost accounting. And then in paragraph 6.10, they have mentioned the alternative basis instead of historical cost as current value accounting. In certain cases where the company is either being wound up, for example, or there is a need to settle a dispute and people want to know about the fair value of net assets, etc., then you have to change the basis of accounting from historical cost to current value method. So current value would consider the fair values as of the as of any cutoff date. So that's what fair value accounting would imply. But again, even under the normal, regular, historical cost convention, also, 99.9% financial statements today, everywhere, in the ordinary course of business, are prepared under historical cost convention. So even if we are following that historical cost convention, what happens is, in quite a few areas of accounting, if you look into the balance sheet, you will find that the standards or IFRS have addressed that you have to make mark to market adjustments, particularly for investments, or for that matter investment property or other areas. You have to make certain adjustments to bring the carrying value of those assets, or for that matter liabilities, to fair value level. So that's those adjustments are called mark to market adjustment. This is called fair value accounting. Mark to market, the business terminology for fair value and impairment accounting. And it fair when you say fair value, it is implying mostly it is implying upward adjustment, kind of a gain. But impairment, on the other hand, is a downward adjustment. So you find that, okay, we have a certain asset which is carried in the balance sheet at a particular value, but you do a detailed review of that asset. You look at the projected cash flows, or about the selling prices, and you find that the fair value has dropped from the amount that is reflected in balance sheet. So what do? You bring it down. The value, you bring it down, and you book a loss. That loss is called impairment loss. Which accounting standard addresses that? Can anybody tell me?
36.
IAS 36, impairment.
Oh, 36.
Yeah. So anyways, shows the current market value or market price of the assets and liabilities. The company's financial statements must reflect the current market value of the assets. This is all fair value accounting. Companies adjust or mark these assets to fair value given by the mark to market adjustment. Calculating the price of an asset when there is market volatility or a financial crisis can result in an inaccuracy of the measurement of the asset's value. One example they have quoted was during March 2023 financial crisis. True fair values of securities held as assets by banks were not reflected accurately. This has happened quite a few times. Even the biggest one was 2008, if you recall. IS 36 is the fair market accounting standard, and it is used when impairing all assets other than excluded assets. Let's go through this activity. For example, which assets are excluded from the scope of IAS 36? The biggest part is inventories IAS 2. Inventories, if there is an impairment in inventories, that will be addressed by IAS 2 itself. Contract assets and assets arising from the cost to obtain or fulfill a contract. So which standard deals with contracts with customers? IFRS 15. This is also excluded. The impairment for such assets, contract assets, will be dealt under IFRS 15 itself. Deferred tax asset, IAS 12 deals with them. So if there is impairment, it will be directly dealt under IAS 12 itself. More assets arising from employee benefits, the pension fund, gratuity fund, etc., etc., provident fund. Those will be dealt under IAS 19, which is employee benefits. Financial assets within the scope of IFRS 9, financial instruments, probably the largest standard, if I am not mistaken. So the all those financial asset categories that have been provided in that have been addressed in IFRS 9, if there is impairment, it will be addressed there itself. Investment property measured at fair value, IS 40. So these will also be addressed there in IS 40 itself. It will not be addressed in IS 36. Biological assets, which is under IS 41, agriculture. So that is also measured at are measured at fair value less cost to sell. So any impairment will be addressed directly in IS 41 itself. Contracts within the scope of IFRS 17, which is insurance contract, very complicated accounting. So, any impairment related questions or fair value questions that will be addressed in IFRS 17 itself. And non-current assets or disposal groups classified as being held for sale in accordance with IFRS 5, non-current assets held for sale and discontinued operations. If there is any impairment implications, they will be addressed directly under IFRS 5. So these were basically exclusions. Okay. IS 36 applies to financial assets classified as subsidiaries as defined in IFRS 10, which is consolidated financial statements, associates under IS 28, joint ventures under IFRS 11, which is joint arrangements, impairment of other financial assets, which is other financial assets, which is covered in IFRS 9. So IFRS 9, only one category that was addressed here. Let me see, held for sale, I believe. Where is IFRS 9? Held for sale, if I remember. Yeah. Financial assets within the scope of IFRS 9, financial instrument. So there is an ambiguity here. Other financial assets which are provided other than the generic types. So we can look at it in detail. Hopefully it will come ahead. Assets and liabilities held on account. It should be held on capital account. Let's read this. In this section, you will learn about assets and liabilities held on capital or revenue account. So, okay, fine. Revenue accounts, those assets and liabilities which are held on revenue account, essentially they are referring to as the working capital. Uh, Essentially, but there can be certain current maturities of those non-current liabilities from financial institutions, etc., that sometimes also become part of the current liabilities, or for that matter current assets, uh, non-current from maturity portion of the non-current assets that will not be included in the definition of assets and liabilities held on revenue account. We will begin with assets held on capital account. That's easier to understand. The assets which a taxable person can elect to be taxed on a realized basis, are assets held on capital account, which is addressed in Article 20, which defines these assets to be those assets that the person does not trade, assets that are eligible for depreciation, or assets treated under applicable accounting standards as property, plant and equipment, investment property, intangible assets or other non-current assets. These are the examples of those assets which are held on capital account. One example has been given. Assume the financial institution's accounting profit was 10 million, but there was an amount of 2.75 million for impairment related to stock in a subsidiary exchange gain. So this was an impairment related to subsidiaries exchange gain. The financial institution could elect to be taxed on this impairment loss on a realization basis. So this is a mark to market adjustment. We estimated that there is an impairment loss coming into investment in subsidiary in the balance sheet of the holding company. So auditors said that there is an impairment we have to book. So, but this has actually not been realized in cash because that investment in subsidiary reflects the share capital into that subsidiary of the parent company. So, what choice do we have? Financial institution or the holding company could elect to be taxed on a realization basis. So, what will happen? This loss will need to be reverted, added back. So, when you add back a loss, what happens? Taxable income goes up. So, their total taxable income will become 12,275,000. Is this point clear? The next one is liabilities held on capital account. Liabilities which a taxable person can elect to be taxed on a realization basis are liabilities held on capital account. There is a definition defines these liabilities held on capital accounts. It has been defined to be liabilities the incurring of which does not give rise to deductible expenditure. That's a beautiful meaning provided. So, for example, when you're taking a loan from a financial institution, does this other than interest, does it give rise to any expense in income statement? No. So, but when you, for example, electricity expense, if you are booking electricity expense, what happens? On one side you book electricity expense debit, on the other side you book accounts payable or electricity expense payable. That's a current liability and it gives rise to an expense that will be expensed out in the income statement. This electricity one, this is a liability held on revenue account, not capital account. So this is the distinction between capital account and revenue account. So the deductions have been addressed in Article 28, by the way. Assets and liabilities held on revenue account, again it's coming up. The assets and liabilities which a taxable person can elect to be taxed on a realization basis are only those assets and liabilities which are held on revenue account. Article 20 clause 4 of the decree law defines assets and liabilities held on revenue account to be assets and liabilities other than those held on capital account. Any point, anyone has any discussion point on this?
Yes, is this a expense? This assets and liability held on the capital account and the revenue account. It's like a expenses and the income and expenses will be revenue account and the assets and liability will be in capital account.
Yes, you could say that. Any expenses that give rise to liabilities, those liabilities will become liabilities held on revenue accounts.
Okay.
Right, but if there is no expense coming up, instead maybe the company is receiving cash for that. That's a
Okay.
financing liability, right? So that will be
Okay.
a capital account nature.
Capital account. That means the balance sheet items, the debit and credit, if it is going to the balance sheet, it will be a capital
Yeah,
item.
very good point raised by you. Yes,
Okay, okay. If it is the entries are going from the P&L and the
well,
balance sheet will be revenue item,
yes, correct.
revenue account.
Yes. So, unrealized gains or losses. Let's have a look at this Article 24. Currency variations are also included through Article 24, 20 clause 4 of this decree law defining unrealized gains or losses to include an unrealized foreign exchange gain or loss. So currency variation, yeah, foreign exchange gain losses, that will also be considered, and accordingly, if there is an adjustment necessary, we can do that depending on whether it relates to capital account or revenue account. Since the financial institution's business is to hold securities, assets, and currencies, and to be funded by monies drawn down using a range of currencies, it is anticipated that the election to be taxed on realization basis will require careful thought from the financial institution before being made, especially since, as currently drafted, this decree law provides no guidance on whether the election is irrevocable, and if made, does not allow cherry picking. But common sense can give you this answer. Yes, the law is silent whether this is revocable or irrevocable, but common sense dictates it, because if you in 1 year you have removed a capital gain, saying that no, we are going to do this on realization basis. Next year it was actually realized, but then you said no, we will, this year we are going to do it on an unrealization basis. So if a company does that, don't you think, Mr. Nauzer, they are simply excluding this entire capital gain from being taxed?
Yes.
So that is why I do not believe that revocation is an option. It will be an irrevocable basis. So assume the financial institution's accounting profit for the 2025 tax period was 10 million, but included in that profit was 3.75 million unrealized foreign exchange gain and a 2.75 million impairment loss related to stock in a subsidiary's exchange gain. Financial institution cannot elect to be taxed on the exchange gain on a realization basis, and the impairment loss on an unrealized basis. Same account, for one thing they are saying that we will do this on an unrealization basis. Other item of the uh, income statement, they are saying we are going to treat this on a realization basis. So naturally it beats logic. So this will not be allowed. If it relates to the same account, and if you're following unrealization basis for the loss, then for gain also you will have to find you have to apply unrealization basis. Now coming to deductions. Article 28 of the decree law addresses deduction. Basically, deduction means expenses, basically whatever is allowed to be deducted from your income to arrive at net taxable income, those are called deductions. Deductions available to a financial institution are the expenses shown in the taxable person's income statement as adjusted. To be deductible, the expenses must be incurred wholly and exclusively for the purposes of taxable person's business. This wholly and exclusively is the keyword here. If it is not wholly and exclusively, then maybe we have to consider whether partially it is applicable, and only that extent of expense will be allowed as a deduction. The expenditure is deductible in the tax period in which the expense was incurred. In relation to the UAE branch of a non-resident financial institution, which is liable to the emirate level tax as well as the federation level tax. Question is whether the emirate level tax is deductible under the law while when calculating the UAE taxable income of the branch. I don't think this question has been answered. To be deductible, the emirate level tax must be expenditure incurred wholly and exclusively for the purpose of taxable person's business that is not capital in nature, subject to the provisions of decree law 2022. Only some expense which is capital in nature cannot be deducted, but other than that can be deducted. So by reading this paragraph, I think this paragraph is implying that if this emirate level taxation is not a capital level item, it can be deducted. But I'm going to reserve my comments on that. Let us read the rest of the discussion. The emirate level tax should be deductible if it exclusively relates to the branch's business and if it is not capital in nature. This may be this sentence we have to address it carefully. Without clarification to the contrary, the FTA is likely to have reasonable grounds to support an argument that the emirate level tax is not an expense which wholly and exclusively relates to the business, because the tax is on profits rather than an expense in earning the profits. And so this is the argument that is being presented. But what about the blocked input VAT then? Don't you think then blocked input VAT should also not be a deduction allowed in the corporate tax? But
No,
people,
no, the
yeah,
no input VAT you are claiming, no, already.
yeah, I'm talking about
You're
blocked.
setting off against the,
No, no,
yes,
I'm
a
talking
blocked
about
one, a blocked one,
blocked
okay,
VAT. I'm
blocked
not talking
one.
about the deductible VAT. That is a given.
Okay.
That's easy to
Yes, yes,
understand, right?
yes.
But what about that VAT, which relates to exempt
Exempt
income,
items.
exempt items?
Mm.
So what do you do then? So there is another article in the corporate tax decree law which specifically addresses deductions not allowed. So we are going to come to that later. Okay.
In general, that the
Yeah.
in general, the taxes is not a deductible expense, no?
Exactly.
In general, yes.
That's what I'm saying. We cannot
It
form a conclusion that quickly. Actually, it's not straightforward to accept that it will be allowable. Let me open.
it's because you can run a business even without paying the taxes also.
No, no. See.
It's not like yes, yes.
There is a question of that sort. What do? We straightforward go to the topic, the article which gives the answer to that. We have to look into that particular article. So I've just opened the decree law, and I'm going to it should be after Article 28 if I understand correctly. Uh, this is our deductible expenditure. There would be another article which is which addresses non-deductible expenditure. Article 33. Can you see, guys? Article 33 is non-deductible expenditure. No deduction is allowed for donations, grants, fines, penalties, bribes, dividends and profit distributions, amounts withdrawn. These are drawings. Corporate tax imposed on taxable person under this decree law, federal level tax. This is not a deductible expense. Input value added tax incurred by a taxable person, that is recoverable. You see, Mr. Nozer, here's the
Yes,
point answer to your question
yes.
and our discussion point. What about the blocked input VAT? This is recoverable input VAT. This is not allowed
Mm.
for deduction, but blocked is allowed. Okay.
Allowed, huh? Blocked is allowed. Yes, but
Blocked.
anyway, we are just automatically including in the cost, no?
Yeah,
That
yeah. I
yes,
mean, if it is,
it's allowable then. Yes,
it becomes
allowable.
allowed. Indirectly, it becomes
Yes,
allowed. Tax,
yes, yes.
tax on income imposed on the taxable person outside the state. So, whatever foreign tax credit is disallowed, that is also not allowed to be deducted. This is a key point for us to remember.
Mm.
Such other expenditure as specified in a decision issued by the cabinet. Under Article 33, if we carefully read, the emirate level taxation has not been mentioned. Am I
Yes,
right in
but yes, but you can. They say that under the decree law you can't deduct income tax. If you income tax you paid under the law, you can't deduct. It could be decree law, it could be emirate law. Both are
No,
same,
no,
no?
no. Hold on. This is a good point raised by you. Does anyone disagree with Mr. Nozer? Abbas?
I couldn't understand the point. So basically, tax paid within the state is not it's not allowed to be deducted, right? That's what the point is.
Nahin, this is not the point. Read this part.
Yeah, exactly. So that's not allowed as an expense, no?
Yes,
Corporate
but
tax paid in the country. Yeah.
yeah, emirate level is tax paid in the state. So your
Yeah,
statement again has a small flaw. Let's address, let's understand very well, guys. Please understand this. The this sentence or this inadmissibility sentence says corporate tax imposed on a taxable person under this decree law. This is specifically addressing federal level taxation, my dears. This is not addressing emirate level taxation.
Mhm.
This decree law means the federal level decree law number 47 of 2022. It is
Yes.
addressing decree law, it is addressing corporate tax under this decree law, which is the federal level corporate tax. So that corporate tax is disallowed. But where does it mention anything on the emirate level tax? It does mention tax imposed on the person outside the state. But emirates are not outside the state, emirates are within the state. So that means Article 33 on non-deductible expenditure is silent on emirate level taxation. That's my conclusion. So I tend to agree with what the author has written here, but again with a lot of skepticism, because later on more decisions have come. So we will we can look into it, and everybody on this call, I am going to request you to look into the later on decisions. If I remember correctly, the decision number 134 is there, and some other decisions are there. We should look into this particular point if it has specifically addressed emirate level taxation anywhere. But if we do not find a reference for this, then I have to agree with the content of this paragraph that emirate level taxation could be allowed as a deduction. Why? Because I do not see, until now I haven't seen anything that makes me believe otherwise. For this purpose, I think emirate level taxation should be allowed as a deduction, unless specifically provided in another decision, because decisions are explanation of the decree law, and sometimes they address matters that have been kept open in the decree law. So they kind of narrow down the scope. Decisions, cabinet decision, ministerial decision. Hmm. Anyways, any comments on that?
What about yes, yes. What about the current practice? Are we deducting the emirate yeah, tax on the from the profit or no?
No, so that's what
Because yes,
I'm telling now. If you really think about it,
yes,
99.9% companies operating in UAE,
yes.
their financial year is Gregorian calendar year, Mr. Nauzer.
Yes, I know that. I'm telling for
So,
oil and gas
uh,
already existing for the taxes. Are we deducting anything from the
boss,
expenses that yes,
boss, that please understand that in the financial statements, if you see their IFRS financial statements, yes, it will be it will be taken into account, and it may appear under the that caption called provision for taxation, because it is a taxation actually. But our concern is not about the presentation in the financial statements. Our concern is whether it is allowed in the corporate tax return or not. You get my point, Mr. Nozer?
yes, yes, yes.
Right? So, in order to answer this question, whether this deduction will be allowed in the corporate income tax return or not, IFRS financial statement is a different matter. We are
Mhm.
talking about the corporate tax return. That question today, what is the date? Today is like 19th. It has only been 19 days, Mr. Nozer, that
Okay.
the 99.9% companies operating in UAE have just
Yes,
started the closure of their financial year.
yes,
First calendar year after the imposition of the decree law, tax decree law.
yes,
So this question will be answered very soon, but we know the prima facie answer. We already know that emirate level taxation, based on our discussion, based on our review of Article 33, prima facie answer is there that we can deduct the emirate level taxation as an expense. However, I'm skeptic on this answer. Why? Because we have to dig deep down inside the cabinet decision and ministerial decisions, just to out of precaution, that if this matter has anywhere specifically been addressed. So this answer we are still evaluating? Prima facie answer is that it is a deductible expenditure. So soon enough, maybe after January or maybe after April, insurance deadline is April. For insurance companies, the deadline for filing their annual financial statements, etc., perhaps is until the end of April. For listed entities, maybe slightly more stringent deadline may be there, but we are going to start looking at these audited financial statements very soon. Right now, this is just 19 days. Large entities, especially, they are still in their closing process. Once their audited financial statements become available, that's when we will by that time when they start filing the return, this matter will be addressed and discussed. As far as second tier practitioners are concerned, why? Because the larger entities, the capital market entities, are being audited by the big four, so they are also looking at it. But they have already made provisions and they have done their treatment addressing this factor across the year, because large entities with the robust accounting system, they make provisions on a monthly basis. They have to file their interim reports also onto the stock exchange, right? So we should be able to get this answer, but for now, to sum it up, this is a deductible expenditure. We will look into it more, and you guys can come back to me to ask this question. I'm inviting you to do this research as well. Okay. Anyways, let us move on. So as we were this was a topic that was discussed for the emirate level taxation. Enough of this discussion. We have to finish this. It's a very long topic. The United States federal tax system allows a deduction for federal tax purposes for US state and local. This is a great example given here. So Mr. Nazar, this is a precedent from United States. So US federal tax system does allow state level deduction. Okay. For example, deduction for US state and local and foreign real property taxes, US state and local personal property taxes, and US state and local and foreign income, war profits, and excess profits taxes. So there is,
This one, number one and two, and all like the property related tax or income related taxes.
yeah, but local taxes is also covered. This is one
Okay,
example. No? Real property taxes is one
property is
example, but
one. Okay,
foreign taxes is
okay,
also another example. Even local
okay.
taxes have been addressed there.
Covered. Okay, okay.
Using the emirate level tax as a credit against the decree law tax lies in Article 44, Clause 3 of the decree law, which states that to the extent there is a residual amount after clause 2 of this article, by using any credits or other forms of relief as specified in a decision issued by the cabinet at the suggestion of the minister. So what we are addressing here is again a very technical assumption, that can we use the emirate level taxation that we paid, emirate level taxation, as a tax credit? That's a question, right? And this question is applicable to whom? Is it applicable to oil and gas sector? Can they even consider
No,
emirate
no,
level
no,
taxation as a
no,
credit? Why? Because they are
no,
out of
no.
they are
Yes,
specifically exempted persons. So they are
yes,
not even
no.
filing corporate tax returns, right?
Okay, only.
So
Yeah,
they have been scoped out to begin with.
yes,
Yeah,
yes.
extraction business, non-extractive, natural resource business, they are excluded from this. What comes next? Financial institutions, banking, bank,
Okay, yes.
banking sector, right? So, what will banking sector think? What kind of a relief do they have for this emirate level taxation? Abbas, what were the types of double taxation relief that we read in our earlier sessions? Can you remember? There were
Yeah,
three types of relief.
I remember
Exemptions,
to go.
exemption and the exemptions and the granting the credit
Okay,
from the
let's hear.
taxes.
Okay, let's hear from Abbas also. Yeah.
What I recall, one of them was to just exclude the income and expenses completely from your
Yes.
tax return. The other
Yes.
was to get a tax credit from your
Ye- yes.
against liability.
And the
I don't
third one?
recall. Third one, I don't recall, unfortunately.
Third one?
Only two, no, only two
No,
or three.
no, Mr. Nazar. I am not talking about UAE corporate tax law only. In our earlier sessions, when we addressed on the model tax convention of OECD, we discussed three different types of double taxation relief. One, you both have given the correct answers for two types. One is exemption, you both right, that we simply exclude the entire income. Why? Because it has already been taxed, right? That is one type of relief, correct? Second category was tax credit, that if we have paid taxation already at the first stage, we use that already paid tax as a tax credit for the federal level taxation. We could consider that. Am I right, Mr. Nauzer? Do you understand what I'm
Yes,
saying?
yes, yes, yes,
That's the
yes.
second
Only
method.
two, no? Oh,
No,
yes,
that's what
second.
I'm trying to tell you. There is a third as well.
Okay.
There is a third as well, but it is not available. It is not black and white written inside the decree law of UAE, but internationally it has been addressed, and there is a lot of discussion available on that. That third method is deduction method. You get my point? Deduction method. Meaning, instead of taking a tax credit for the emirate level taxation, I understand well what I am trying to say here. Instead of taking a tax credit for the emirate level taxation and deducting it from the tax liability, the authority may say that, this is not a tax credit, but it is a deductible expenditure. You get my point? So it will not
You
come
mean yes, you mean you put the tax paid amount as a
as an expense.
deduction from the
Yes,
yeah,
as a
deductible
deduct.
expense.
Exactly.
Yes, but the if you deduct from the tax outstanding, tax payable, it will give you the more like a less.
More benefit.
Yes, it's
It
more
will give
benefit.
you, yeah, because then it is reducing your tax liability. So the
Yes.
question is that how should we look at this emirate level taxation, right? So if a client asks you this question, Mr. Nazar, how will you respond to it? That what will be the prudent way of dealing with this? Will you suggest to the client that you could consider it as a tax credit if you have paid taxation at emirate level? Would this be your answer, or would you
No,
go for
no,
the other answer
no.
that you should consider it as a deduction?
Yes, yes. Second deduction one.
Why? Because that's the prudent measure. And
Yes,
besides
yes.
that, this argument is not actually the answer that we should be giving to the client, that this is a prudent measure. No. Our answer is based on the provisions on tax credit available in the decree law. How many types of tax credit are provided in the decree law? Can you recall? UAE,
Foreign tax. Yes, foreign
foreign
tax
tax credit,
credit,
correct? Withholding tax.
withholding.
That's it. These are the only two tax credits that have been provided. Am I right, Abbas?
Yeah, yeah.
So our answer, prudent, prudence is only an additional bonus factor on that. We can say that it meets the prudence criteria as well, but that's not the real reason. The real reason is that the only two types of tax credits provided in the decree law are either foreign tax credit or withholding tax credit. That's it. Okay. So good. Yes.
Yeah, so, sorry, so when we talk about emirate level tax, like,
Mhm.
so when it comes to the emirate level tax law, how would, like, because what I'm thinking is that, like, income tax is being paid
Mm.
on income, right, basically. So
Correct.
how does emirate level tax define as the tax being paid? Like, what's the tax on? Because I think that could sort of help us to sort of decide where should we fit in this emirate level tax as like a deduction or like a tax slab or a tax
Okay,
credit, because
so a good point. This gives rise to a rather more philosophical discussion on the type of tax that we are addressing. So,
exactly.
if you internationally, if you see, I'm choosing the words very carefully. Please pay attention to what I'm saying, Mr. Nauzer, as well. uh, if I have to choose the words, I would choose the superset as business tax. I would not call it corporate tax. I will call it business tax, which is probably the international terminology that is used. So if you look into the various frameworks of the world or tax frameworks of the world, sometimes it is called income tax, sometimes it is called corporate tax. For example, in certain countries of the world, it is called business receipts tax. If you even look into the Pakistani or Indian tax laws, sometimes a particular type of tax is referred to as final regime tax, final tax, or minimum tax on turnover. You might have heard these terminologies. Am I right?
Yes.
In Afghanistan, there is a direct tax called business receipts tax, which is 2% of the overall revenue. That is also part of the business tax. So that's what I'm trying to say here, that corporate tax, which is directly applied on the bottom line profit before tax, this is one type of business tax. There can be other types of business tax as well. So the emirate level tax on oil and gas, Abbas, actually it is applied directly on revenue. Whatever revenue is, whatever billings are generated from the extraction of the petroleum, for example, the gross production, you apply 45% or 55% level of taxation on that. So that's a revenue tax, if you revenue share tax.
Okay.
But it is still a type of business tax. You get my point?
It's like a sales
Yeah,
tax.
yeah,
We
yeah.
call
No, no,
India, and it's like we call sales tax.
no, 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 no. It's not a sales tax, boss. Sales tax uses the overall revenue as the base. Business tax, on the other hand, does not use overall revenue as the base. It deducts from that revenue itself. There's a huge difference, Mr. Nozer. Sales tax uses the entire revenue. 100 dirhams, let's say, is
Okay.
the entire
Yes,
revenue.
yes, gross.
On
Okay.
it will be used as the base of that sales tax, and on top of that, sales tax will be added. But revenue tax is actually 100 dirhams. Out of that 100 dirhams of revenue, 55 is being taken as the tax, and withheld, or retained by the emirate. This is
Yeah,
revenue tax.
without any, without deducting anything, just
uh,
from the revenue of the
Revenue
revenue,
tax,
oil
exactly.
revenue, you take 45 or 55.
45 or 55%. So, Abbas, did I answer your question? Was your question like addressed properly?
Yeah. So, but then, so if we're saying that the emirate level tax is still a business tax, it's a business tax.
It is a business tax.
So it is a business tax. Hmm.
So if it is a
Okay.
business tax, the question will come that what do we do with this business tax?
Yeah.
Whatever. See, we understand the high level nature of the tax, right? That was the key question here. That we have to understand the
Yeah.
high
Yeah.
level nature of the tax that we
Yeah.
determined as a business tax.
Business
Now
tax.
the second question will come that whatever the nomenclature, we understood the nature of the tax. Now we have to decide what to do with that payment. So
Hmm.
that's when the second aspect of the
Yeah.
discussion comes in, which has been addressed under Model Tax Convention.
Yeah.
That how do we deal with this? Shall we consider it as a tax credit, or shall we apply the exemption approach, or shall we treat it as a tax deduction? Sorry, shall we treat it as a deductible expense? For the taxable income. So until now, the conclusion is that we have to consider it up till now as a deductible item, deductible expense.
Yeah.
Okay.
Yeah.
Example: assume the UAE branch of a non-resident financial institution had a 10 million dirham taxable income from UAE sources and had paid 450,000 emirate level taxation. Without clarity on the decree law or from the FTA, it is unclear whether the taxable person is required to return a 10 million income for decree law purposes, or whether it is entitled to return 9,550,000. Why? Because we have to consider what do we do with this 450,000. This was an example, but naturally we will conclude on this. All the tax practitioners like me and in other practices in UAE, we will come to a conclusion soon enough. We have already come to a prima facie conclusion. And I don't recall anything in any decision, to be quite honest. So I think we will go with the same deductible expense treatment, unless any contrary clarification appears. So, anyways, deduction limitations. Article 30 of the decree law limits the deduction of interest expenditure. So, this is a very key topic here, but people have complicated it, but it's not all that complex. We will just for remembrance purposes, we are going to address it in a simple manner. So the general rule, when the first decree law came, it identified 30% of the EBITDA, but there was not clarity on what is meant by EBITDA. For example, is it accounting EBITDA, is it tax EBITDA? So these questions came, right? The interest limitation rule does not apply to financial institutions. uh, so why? Because their very nature is earning the interest income and paying out the interest expense. And if you really think about it, uh, uh, I'm going to raise a very simple question. What is the topic that we are discussing here? Interest
Limitation of
deduction,
reduction.
limitation or deduction of interest, correct? Now, my question is, what about that organization whose entire income, or a substantial part of the income is interest? What are you going to do for that entity? Their entire income is interest income, and the decree law addresses it as net interest expenditure. If you remember our previous sessions, the deduction that we are looking at is called net interest expenditure, meaning whatever interest expense came into the financial statement minus interest income. But what if the order of that is reversed? Then it does not remain a deduction, right? Because income is higher, deduction, expense is less. That is why common sense tells us that for financial institutions which are by default going to have a higher interest income, this will not even be applicable. A bank is defined in the decree law number 47 to be a person licensed in the UAE as a bank or finance institution or an equivalent licensed activity that allows taking of deposits and granting of credits as defined in the applicable UAE legislation. Keyword applicable UAE legislation. What is meant by that? Anybody? For banks, what would be applicable UAE legislation defining what is called a bank? This applicable UAE legislation is going to define what is, which ones are banks. What could be that? One example I gave you at the beginning of the lecture. Central bank regulations, boss. Central Bank of UAE. But that Central Bank of UAE regulations directly address those banks or financial institutions which are in the mainland. But then again, I mentioned two more. You remember? DIFC and ADGM. They have, we read it in our earlier modules, that they have their own prudential frameworks, very detailed level. So we have to refer to all these three main frameworks. That is going to provide us the definition of what is banks. So if you guys want to look at this, I think I have written an article as well. DFSA versus BFSI. Let me look at it. Maybe we will find it. Yeah, this one. So I'm just going to mention this, short. I'm just going to mention this URL here for your quick reference point, so that you guys can always, you guys can refer back. Let me paste the topic here. It provides a summary of the DIFC various financial activities that are there and the tax consequences. That's a detailed research. You guys can refer to this article. So anyways, this means that a bank's interest expense should not be Article 30 limited, but the drafting leaves unclear whether a financial institution needs to be a deposit taker to also fall outside the limitation. So, some financial institutions are not deposit takers. They only, certain categories are not allowed to take deposits, only extend credits. So, it is not very clear, but it will be decided on a case to case basis. We have to remember a high level point here, that if an entity is defined as a bank, then this interest deduction limitation of 30% of EBITDA does not apply. Any questions up till now? Okay, we're going to go forward. Carry forward losses. There should not be any difference in the applicability of loss recoupment rules if the company reclaims a prior year loss is a financial institution or not. So, those losses which were pre-tax losses, naturally they are not allowed. Am I right in this?
Yes.
But what about those losses which have incurred after the company became taxable, after the tax registration was achieved? How long can they carry forward losses, Mr. Nawzer? Up to
10
how many
years?
years? Up to 10
10
years.
years.
What about you, Abbas? What is your view?
It's infinite.
Exactly. Mr. Nawzer, correct your understanding.
Mm.
It's not 10 years,
Okay, infinite. Okay, infinite.
infinite. Losses incurred by financial institutions are subject to Article 39 of the decree law. So it gives, there are two tests provided for. Continuing shareholder test. So the capital structure should not change. Same or similar business or business activity test, which is again Article 39 Clause 2. So the core income generating activities should not change. Were the financial institution stock to be listed on a recognized stock exchange, then the tests determine whether the losses can be recouped do not apply. So listed banks, these tests do not need to be done. But if it is not a listed bank, then we have to make sure that for a specified duration, for the tax period, the shareholders should not change, and the core income generating activity, the business activity, should not change. There is a ministerial decision as well,
Yes.
126.
Excuse me, this the condition he told me that you need to satisfy the both condition, no one condition.
Both conditions. It is a
Both, huh?
simultaneous, yes, both
It's
conditions,
both. It's not
both,
one, either
not
one.
one,
Okay.
simultaneously. Ministerial decision number 126 of 2023 on general interest deduction limitation rule for the purpose of this decree law should be taken into account. It's a decision, ministerial decision issued into 23 that addresses interest deduction limitations. So we can do a reference from there itself to, some more details have been specified there. But in general, carry forward is losses is carry forward of losses is infinite. A recognized stock exchange is any stock exchange established in the UAE that is licensed, regulated by the relevant competent authority, or this is another key factor, or any stock exchange established outside the UAE of equal standing. So if it is London Stock Exchange or NICE, etc., then it will be considered as a recognized stock exchange. Tax group and withholding tax. I think this we have addressed previously as well, but let us read again. The provisions setting the conditions for forming and terminating a tax group, together with the provisions governing the operating of a tax group, so are equally applicable to a financial institution as they are applicable to non-financial institution. So tax group, you remember guys, what was some of the conditions, if you can recall? Can somebody tell me what were the broad conditions of formation of a tax group? For example, let me ask you, can a non-resident person be a member of a tax group? What is the answer?
Yes. Yes.
Yes. What about you, Abbas?
I don't recall, to be honest.
The
No,
answer is no. Yes. Whoever answered this, he's right. Who said that?
Mujaddid.
Mujaddid, right. So non-resident cannot be a member of tax group. Can a natural person be a member of tax group?
No.
No,
No.
correct. So good. What about a branch? Can a branch be a member of tax group?
No.
No.
Are you sure?
Yes.
Whoever said no, all of you are wrong. Do you know why? I'll tell you why. Let me see if I can go to the decree law. Yeah. Let's close this. So what are the conditions for someone to be a member of the tax group, what are the conditions? It has to be a resident person, correct?
Yes.
Second condition, it cannot be a natural person, it has to be a juridical person, correct?
Yes.
So, branches, in your view, what are they? Are they natural persons? No, correct? They are not natural persons. But, okay, let me quickly find out resident. Can you see this? Article 11 defines resident person, correct? So let us go to Article 11. Mujaddid, let us read the resident person definition here. This is resident person, right? What does it say? A juridical person that is incorporated or otherwise established or recognized under the applicable legislation, including a free zone person. But what about branches? Are they juridical persons or not?
Yes,
Yes.
juridical.
Yes,
Yes.
they are. Yeah.
They are. So a branch can be a member of the tax group, just to let you know. Okay, guys? They are,
Even
yeah,
But Mr. Altaf,
even free
isn't it?
zone.
yeah. Kalima, you were saying something?
No, but branch is not a separate entity, right? It's just an extension of the main company. So
Correct.
isn't there that ownership condition also there, the 95% ownership, an ultimate parent, and also in that case, wouldn't this will this point be valid about the branch being part of a tax group?
Yeah, so permanent establishment, if you, I mean, that's a good valid point. We can, okay, let us look at the tax group. That's it. Let us go to the Article 40. Here it is. If the 95% control is exercised, yes, it would be there. So the branch, neither the parent company or subsidiary is an exempt person. So I think I mixed two concepts here, because 95% absolutely right. I think Kalma has a point here. 95% shareholdership is required, and branch is an extension of a non-resident person. So that creates a question.
Yeah, and also I think most of the times branches do not have separate set of financial statements most of the times. So
They
if that's the case,
no. Hold on a second. As a permanent establishment, Mujaddid, in UAE, as a permanent establishment, since branches have to register as well for tax, they will be required. Even within the UAE law framework itself, branches are required to have a separate set of financial statements. So as far as financial statements go, they will have that information. But the question, actually, the where the challenge comes in is 95%. This is a key point. I will I will not give this answer yet, but apparently this 95% question is a big question. So if this branch is an extension of a non-resident person, then yes, there it becomes a bit of a pickle, because then it cannot be included in the tax group unless that
Yes.
person does not remain a non-resident person. If it becomes a resident person, even if it is outside UAE, you remember there is a category of persons, of companies which are not incorporated in UAE. They're incorporated outside of UAE, but they are still resident person. You remember this point?
Yes.
Second category of residents, which is addressed in Article 11. So there is a separate category of resident companies which is not even incorporated in UAE. So from that perspective, Mujaddid and Kalima, both of you raised a valid point. I retract my answer, where I said that branches can become part of tax group, but I don't entirely retract my answer. I remember some discussion around that. We will address this question in the WhatsApp group again. But apparently, this 95% rule may be a reason to question whether a branch can be part of a tax group. So, the very good point, very valid point raised by both of you. So we will address this, but if this 95% test is not being met, then branches will not be able to become part of a tax group. Yes, agreed.
I think that's building on this point. Um, a branch cannot be a subsidiary, and I think the tax group section only talks about subsidiaries. So
Yeah,
even if we consider that a branch could not be a part of a tax group, then
yeah, you are right, Abbas. In that sense, you are right. The only you are right.
Also, Ms. Altaf,
Actually,
you specified that parent and subsidiary rule is the main one
main
for
rule
tax group.
exactly. Yeah, but because otherwise, foreign company. Whenever we use the word foreign company, it is wrong to assume by default that it is a non-resident company. But permanent establishment, often non-resident, that is the only thing that gets a branch status. So generally speaking, I tend to concur with what you guys are saying, that yes, apparently this 95% rule will be violated if we consider branch to be included as a part of a tax group. I agree with that. I agree with that. So we will park this until now. I will accept what you guys are saying. I agree with that. Were the withholding rate to increase from 0%? What is that 0% rate? Can withholding tax rate in UAE is currently 0%.
Exactly.
If if the withholding rates were to increase from 0%, then the withholding rate for interest paid by a financial institution would be a lower rate than the rate to be deducted from interest payable by a non-financial institution. This is because withholding rates in most OECD jurisdictions continues to be 0% on interest. That's a scenario point raised here, that what is the economic rationale. So around the world, withholding tax deduction on interest is very minimal. So what they are saying is it will be probably less than those businesses which are non-financial businesses. But naturally, this is only a scenario. We cannot comment on that. When it comes, we will find out. Freelancers. Now, what would freelancers mean? Let us have a look at it. This section comments on the provisions applicable to a freelancer. I think what they're referring to is the freelancer status of business, whereby one natural person, freelancer refers to an individual, a natural person. How are they taxed? When calculating the taxable income, but does not comment on the license a freelancer should obtain before providing freelance services. Because if you really think about it, in one corporate tax guide, the sole establishment has clearly been written as having the status of a natural person. You remember, Abbas, have you read that guide? Natural person, sole establishment. Again, sole establishment has been provided the status of a natural person. So that may also be covered under the freelancers. It is generally understood that a freelancer is a person, natural person actually, carrying out particular pieces of work for different organizations rather than working continuously for a single organization. That's a Cambridge dictionary. A juridical person may also be a freelancer in UAE should it be legally entitled to function in a similar manner to that which a natural individual freelancer functions. So this is the viewpoint of the author, that a juridical person, legal entity, can also be a freelancer. I fail to understand how, but generally speaking, freelancers are natural persons. Freelancer will be liable to the business taxation if functioning as a freelancer falls within the definition of a business or business activity. So yeah, and this is freelancers are issued a business license basically, usually service. A juridical person carrying on a freelancer business is a taxable person, and as such will be liable to the business taxation. That's a given, right? We don't even need to worry whether it is a freelancer or not. Juridical persons, if conducting a business activity, they are by default subject to tax. But the main question here is not about juridical person, it about natural person. Let's discuss further. Cabinet decision number 49 of 2023 on specifying the categories of business or business activities conducted by a resident or non-resident natural person. Now this was our point of concern. This was our point of discussion. That are subject to corporate tax has already been issued. So in this cabinet decision number 49, we can find the categories of business or business activities that a natural person undertakes, which will be subject to corporate tax. A business is any activity conducted regularly on an ongoing and independent basis by any person and in any location, such as this is the definition of business. I think dozens of times we have addressed it. By now you guys should remember it by heart. You remember these three categories: regularly, ongoing, independent. Anybody can remember? Let me just take a quick quiz. What would be the meaning of the word independent, Mr. Nauzer? Others will be able to answer, by the way. Kalma or Mujaddid or Abbas, they should remember this by now. Okay, Mr. Nauzer is not answering. Anybody else? Dependent agent, remember?
You are not an agent of someone.
Yeah, so what is the difference between independent basis and dependent basis? There is a concept of dependent agent. So guys, if someone is under the employment of a company, that person is financially, economically and legally dependent
Dependent.
on the employer, right? So that precludes the independent basis assumption. So that will no longer remain a business. It will become a dependent agent. Ongoing refers to going concern assumption. Regularly implies the repetitive nature of business, right? It's not a one-off thing by a person and in any locations other, and the examples could be industrial, commercial, agricultural, vocational, etc. Any locations mean it can be done in any from any part of the world. It can be on remote basis as well. So that's the definition of business. Why did they repeat? Why did they bring this definition from Article 1 of the decree law? Just to build on the discussion of natural person conducting a business or business activity. Tax rates. Which article addresses tax rates? Come on, guys.
Article 3.
Article 3. How many
No,
regimes? How many
okay,
regimes?
yes.
How many regimes, Mr. Nazar? 2 regimes or
The
3 regimes?
two,
My God, come on.
Three,
two regimes.
Come on.
three regimes.
3 regimes. We have discussed this so many times. Can you answer the names of those regimes? One is the normal regime, right? Default regime
Yes.
0%, 375K, and above that 9. That this is the default or normal regime. What is the other regime?
Top up regime, the 15%.
Yeah, so and then qualifying free zone person regime. First regime is normal tax regime, second is qualifying free zone person regime, third one is top up regime. But this top up regime is not apparently written inside the original decree law. Am I right in this?
Yes. Yes.
It was introduced later through another decree law number 60.
This is for
Uh,
transfer pricing, no? The top-up regime for foreign, it's like for transfer pricing entities, huh?
it's you could call it transfer pricing, but it is something bigger than that. Transfer pricing is a subset of international taxation. You could say that it is based on the Pillar 2 recommendation that larger entities operating in more than one jurisdictions reaching 750
Yes.
million euros and above,
Yes.
they are
Yes. Yes.
they are
It is for MNE,
is for MNEs. Yes.
not for local companies.
Yes, correct. Multinational enterprises. So, natural person and juridical person freelancer will be liable to corporate taxation uh, under the decree law. Article 31A, which is the normal tax regime, applies the same rate of tax. Can a freelancer then become member of like a qualifying free zone person? What is a freelancer? Does the freelancer involve in trading activity as well, or can it only be services?
Yes. Trading also.
It could be
If
trading as well.
It could be. I mean, there is no definition written in the decree law, so we don't know. I mean, it can be a trading activity as well. But if it is, I mean, what we have read previously is that freelancer can be a juridical person also. But what if it is a natural person? Then that person will be excluded from the qualifying free zone person regime. Some examples. Assume a freelancer's function is defined to fall within a business or business activity of a natural person. Assume that the natural person earned book profits of 960K. After the 375K threshold, the freelancer will only have how much? 585K of taxable income, which would be liable to 9% tax, namely 52,650. That's excluding the 375K. Assume a juridical person freelancer earned book profit of 960K before claiming 8500K deduction for an arm's length salary paid to the freelance company stockholder. After the 375K threshold, the freelancer company would have 85,000 dirhams taxable income, which would be liable to 9% tax, which is 7,650. Mr. Nazar, you see this point? It is a deduction for salary paid to the freelancer. Okay,
Yes.
so that means arm's length salaries are allowable deduction even if they are paid to the shareholders.
How do we define the arm's length? Where we can get this information? This
Arm's length
this
is
no
yeah.
uh, the salary of like 500 100,000.
The
Do we have any benchmarking for the the salaries? So
the
the
the entire transfer pricing doctrine rests on this word arm's length, Mr. Nazar. So
okay.
that this is the $1 million question of what is arm's length. Okay, the entire hundreds of pages have been written on this. Uh, for salaries, for example, you can look into the market data. Benchmarking softwares are available. Companies like Hayes and
Because
Robert Half, etc. They publish their benchmarking surveys. Various information is available from
yes.
which we
So
can
because, yes, because Australia, the ATO, they himself like publish every year benchmarking for the businesses and the industry wise also, the turnover wise also. They every year you
they
can get
publish
it
it.
from the website. If you go, if you're in a restaurant business, they will say your GP, the GP should be this much, your salary should be this much. Everything will be available in benchmarking. If you go below the benchmarking, then audit will be triggered.
Correct. So if you remember the module on transfer pricing, we read multiple things. The controllable unprice, controllable क्या था यार? Comparable uncontrolled price cup method, and we also mentioned an indirect method TNMM, transactional net margin method. Different things are available. Uh, Different approaches are available to conclude, but uh, in summary, the arm's length is a price that you would pay to a third party, independent third party, rather than a related person. So if that meets the criteria, that will be arm's length. These examples show the tax benefit from incorporation, providing the compensation paid to the related person is arm's length. Without that, the deduction will be disallowed. The freelancer, natural or juridical person, may qualify for the small business relief. Can somebody remember what was that relief about? Something on 3 million dirhams? Nobody remembers it? Okay. The small business
If,
relief rules are
if
detailed.
you if you make less than 3 million dirhams, if a business make less than 3 million dirhams, it will be eligible for small business relief.
Can you improve your sentence by further clarifying? Are you referring to profits or revenues? 3
Uh,
million. Yeah.
revenues.
Revenue.
Correct, correct. That's the correct statement. If a business earned earns revenues up to 3 million dirhams, they can qualify for small business relief. But this relief is available until which year?
2026.
Very good. And the preceding 2-year rule, can you remember? There is a, yeah, Mujaddid.
Yeah, like you cannot claim it. For example, the preceding 2 years, if you claim one time this small business relief.
No, it was not like that. If your this year and previous year income, both of these income have to be less than 3 million dirham. If last year your income was more than 3 million dirham, then you cannot claim small business relief this year. That was the rule, 2 years rule. Okay. Article 21 of the decree law establishes that for the taxable person to qualify for the small business relief, person must firstly be a resident person. That's the key point. Non-resident persons cannot claim small business relief in the UAE for taxation purpose. This means non-resident individuals, non-resident companies cannot claim. So the ministerial decisions detail is summarized. Let's look at the ministerial decision. Taxable person's revenue threshold for the relevant tax period and previous tax period is 3 million dirham for each tax period and applies to tax periods commencing on or after 1 June 2023. Naturally, all taxation applies after 1 June 2023. So, this year and previous year the revenue should be within the threshold of 3 million dirham. The threshold continues to apply to subsequent tax periods ending before 31st December 2026. Whoever answered, very good, correct answers. This means that as the rules presently stand, they cease to apply from 31st December 2026. Revenue has been defined as the gross amount of income derived during a tax period. So, taxable person cannot elect to apply the small business relief if the person's revenue in the relevant period. This is a discussion we have already done. The previous year it cannot be high. Small business relief additional conditions. Okay, let's have a look at additional conditions. A resident person electing to apply the small business relief must not be a constituent company of an MNE. You remember the MNE rules, 750 million euros, right? Or it cannot be a qualifying free zone person. So if the MNE rule apply, then it doesn't matter what was your revenue. It can be 1 lakh dirhams only, 100,000 dirhams only, and you will still not be able to get the benefit of small business relief if you are part of an MNE group. Okay, there are companies, let me tell you, we recently onboarded some clients which are part of multinational enterprises with 750 million euros or above, and their income in UAE is it's in one case non-existent, in another case less than a million dirhams, and they will still not be eligible for small business relief. Cabinet Decision 44 defines a constituent entity to mean any one of any separate business unit of an MNE group that is included in the consolidated financial statements of the MNE group when preparing the financial reports, or would be included if equity interests were traded on a public securities exchange. That is one example, a listed entity. But branches are also, permanent establishments are also included. We will see that. Any business unit that is excluded from the MNE group's consolidated financial statements solely on size or materiality grounds, or third category is any permanent establishment pertaining to any separate business unit of the MNE group referred to clause 1. So that refers to branches. Even branches and permanent establishment will also be considered as constituent entities of that multinational enterprise, and if that happens, what is the result? Small business relief is gone.
So for such a company who has a parent company outside of the UAE, they would be taxed at what rate? At 15% or 15%?
15%. 15. If it,
15%.
yeah, 15%. Even if their revenue is very, very minimal, but they're part of a multinational enterprise, they will be taxed at 15%.
15%, right.
A qualifying free zone person is, I think, again, they're repeating the definition, but by now it should be, in your subconscious by now that what is a qualifying free zone person. Mr. Nazar, can you answer this question quickly? What is a qualifying person? Who is a qualifying free zone person? There are some conditions, right? In Article 18.
Yes, any business set up in free zone,
Okay,
and
well, meaning it has to be a free zone person, first of all.
yes, free
Okay,
zone.
what conditions are provided in Article 18? Any condition you remember? Free zone
Yes,
person, though
yeah,
it
yes,
is
free zone per
included in the name.
person, and plus the free zone, income generated from the qualified
It's
activities.
okay, yeah. So you could call it qualifying income, right?
Yes,
That
yes,
person should be
qualified.
earning qualifying income. Any other thing?
Yes, it's maintaining the presence in the free zone.
Substance, economic substance.
Yes, it is.
Yeah.
Yes.
So it should have economic substance. It should earn qualifying income. What else was there? It should comply with transfer pricing related documentation and arm's length principle. What else was there? It should not elect for the normal tax regime under Article 19, right? So all of these conditions were there in Article 19. So anyways, moving forward to the next example, the incorporated freelance company is a qualifying free zone person with revenue during the following tax period: 2024 82.5 million and 2025 82.9 million. So this is an example. Even though the income is below the threshold, the small business relief is not available due to the company being a qualifying free zone person. These are less than 3 million dirhams, but they will not become qualifying. They will not be able to get the benefit of small business relief because they are qualifying free zone persons.
Sorry. If a qualifying free zone company is part of an M&E group, what happens
Wow.
then?
They are killed because
Okay.
bo because both
Yes.
both both conditions are detrimental. First of all, it is a qualifying free zone person. Even if it were not an M&E, it would not get small business relief,
Yeah.
right?
Yeah.
Secondly, it is an M&E poor company will be already subject to 15%
They
rate.
would. Yeah.
Yeah.
Okay.
So that's how it is. But that's a good question actually, Abbas. If you're asking this, what would be the status that it is I mean, it fulfills the conditions of qualifying free zone. It can earn qualifying income, right? That's the key point here. If
Yeah.
it is a part of a multinational enterprise and if it is earning a qualifying income, how will we treat that? Right?
Hmm.
That's a
Yeah.
question you're asking, right?
Yeah.
So,
Exactly.
so that's a valid question. Uh, we have to refer to the recent decision on the minimum tax regime, which explains it. If that entity is earning, if that entity is into one of the activities that are qualifying activities, uh, but at the same time it is subject to tax at 15%, we have to see. But probably that entity will end up getting the benefit of being a qualifying free zone person. But honestly speaking, we have to look into it in a bit more detail. How will we
Hmm.
deal with that? Because that's on a worldwide level, it is a multinational enterprise. But within UAE, it is fulfilling the conditions of qualifying free zone person. So
Yeah.
that's that. These are two extreme ends, right? I mean, the topic that we were studying, that answer is pretty easy, pretty simple. Small business
Hmm.
relief will not be allowed, right?
Yeah.
But the other question, it raises another question, which I invite you guys also to do some research on, is how will we deal with this extreme scenario? On one side, the entity is fulfilling all the check boxes of a qualifying free zone person. I mean, I'm not calling it a qualifying free zone person. All I'm saying is that an entity is fulfilling all the criteria of a qualifying free zone person. It has the type of income that can be positioned as the qualifying income. It has economic substance. It is, complying with other transfer pricing related documents, etc. And it is a multinational enterprise. Now, what do we do? Should we tax it at an extreme 15%, or should we tax it at 0%? Right? That's a good case. I think the answer would lie in the M&E rules, the decision that has been. Please write this question, Abbas, into the into the WhatsApp group, and what I would do and what I would ask somebody, Mr. Nazar, can you mute? Yeah. So what we will do is we will have a look at the decision that was issued on multinational enterprise and this top up tax regime. It chances are that it would have the answer to it. If most probably it will have the answer to it. So if it we have to see. I cannot answer this question immediate basis because this is an extreme scenario. So we have to look and do some more research into it. Article 4 and 5. In this section, you will learn Article 4, we know exemption. What about Article 5? This is connected to Article 4. We'll look at that. Exemption, it is all again related to exemption. You will learn more about two of the small business relief rules detailed in Ministerial Decision number 73. Let us have a look at it. Where the small business relief is made in a tax period, any tax losses incurred in that tax period cannot be carried forward. So it's like a tax holiday. So the person who has been successful in achieving the small business relief, that person enjoys tax holiday. What does that mean? That person does not file a corporate tax return. That person, but at the same time, that person cannot claim the tax losses during that holiday, during that tax holiday. That those losses cannot be carried forward to any subsequent tax period, while any unutilized tax losses incurred in previous tax periods where an election to apply the small business relief was not made may be carried forward. So, carrying forward of tax losses is inversely related to uh, small business relief basically. May be carried forward to subsequent tax period. Example, let's have a look at an example. A mainland LLC freelancer incurred 115,000 dirhams of losses in 2024, but a profit of 295,000 in 2025. In 2025, the company derived revenue of 2 million dirham, naturally less than 3 million, right? So SBR is available. And in 2026, derived 2.1, again less than 3 million. Apparently, SBR is available. The company should not claim the small business relief in 2025 because after the 375k threshold, its tax liability would be AD0 and the losses could be adjusted from profits earned in 2020. Very beautiful example, very nice example. Mr. Nazar, can you comment on this example? Did you understand what is written here? Mr. Nazar, can you please unmute?
Yes, I'm reading now.
This is a very good how do you say kind of a question which is purely practice oriented question. See, in the first year, how much was the total revenue? In 2025, the revenue was 2 million. 2026, the revenue was 2.1 million, right? So in 2024, the losses were 115,000. 2024 losses. So if they claim small business relief, so would they be able to carry forward these losses 115,000?
If they claim small business relief, then no.
Yes, they will not be able to carry forward this loss, right? And so that means they will need to pay profit on this 295k. But again, in 2025 also their revenue was less. If they did not claim the small business relief neither in 2025 nor in 2024, they will be this loss will be carried forward. In 2025, there is a there is a profit of 295K, they can offset it. 295 minus 115, if you look at it, the net amount is still below taxable threshold. Am I right? So they will not end up, they will not pay anything in taxes, and there is no mention of any losses. But let's read the last part. The company should not claim small business relief in 2025 because after the 375K threshold, its tax liability would still be zero, and the losses could be adjusted from profits earned in the 2026 year onward. So tricky situation here, but the general, I can summarize this in a different manner. If you have tax losses, you have projected that there will be tax losses during the tax period, and your revenue is also, uh, uh, less than 3 million dirham. You have a choice to either claim a small business relief or not claim the small business relief. In that scenario, where you can project that there will be losses in that year, claiming small business relief is going to deprive the company of the benefit of those losses. That's the general rule. Mr. Nazar, did you understand my point?
Yes, 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 yes.
So they should not.
Do you need to do this election on a yearly basis, or you have to do it like a one-time thing for the
So,
SBI?
small business relief, Abbas, is a very limited time offer. If you
Yeah,
really think about it,
yeah,
it's almost over. This is 2025 beginning, right? And next year is the end of it. So if okay, let us create a scenario right now. So right, this is month of January of 2025. Am I right? So,
yes,
generally speaking, any tax clients that you will get, they will be filing their first corporate tax return. Am I right?
yes.
So, 2024 financial statements would be in front of you, right? So, you will have to look at those financial statements. First question you will need to ask, is this company eligible for small business relief or not? Okay, let's assume that the company is eligible for small business relief. Fine. Then the second question that you would need to ask yourself is, should we claim this relief right now? If there is a loss in 2024, the answer becomes very obvious. Am I right, Abbas?
Yeah, obviously. You should
Then
not.
they should not claim. Why? Because
Hmm.
if they claim small business relief, this loss is gone. 2024 loss is
Yeah.
gone. They cannot carry it forward. Uh, and at the same time, this is not an isolated decision as well. We have to look at the 2025 projection also and 2026 projection also. Uh, that is easy to decide on the 2024, that if there is a loss, we are not going to claim small business relief. But what about 2025? If it's a very case to case situation. Even there could be a projected loss in 2025. So again, small business relief should not be claimed, because you will be then losing the benefit of that loss in the subsequent periods. But what if there is a profit projected in 2025, Abbas? Again, we have to do a calculation. We have to look that how much is that profit. If that profit is less than the 2024 loss, then again we should not claim it. Or again, it depends on projection of 2025 as well as 2026. So this decision should come as a result of projection of not only 2025 but also 2026. Only then we should claim or decide on whether we should claim small business relief or not.
Okay.
Okay, so moving forward on the net interest expenditure, as the name suggests, whenever we talk about interest in the corporate tax law, UAE corporate tax law, we always address net interest expenditure. Is the interest expenditure amount that exceeds the interest income amount determined in accordance with the provision of Article 7 of Article 47 of the decree law. Any net interest expenditure incurred in previous tax periods where an election to apply the small business relief was not made, we did not go for the relief, may be carried forward. If we had claimed small business relief, then even that benefit of net interest expenditure will be lost. Uh, what is this? You remember why are we even talking about carrying forward of the next net interest expenditure? Can somebody tell me? Mujaddid maybe or Kalma?
Because we can only claim up to 75% of the taxable income. So we may have some remaining 25%, which we can utilize the
No, no,
net.
no. You didn't understand the question. It seems. Kalma,
30%. We can claim only 30%.
yes, that's the answer, Mr. Nazar. Right answer. Actually, the Mujaddid, if you recall, what is the rule for net interest expenditure? You remember? 30% of
Yes,
tax EBITDA.
30%. Yes,
So you can claim up to 30% of tax EBITDA, right? But
yes.
what Mr. Nazar may have forgotten is that there is another rule called safe harbor. Mr. Nazar, are you aware of the safe harbor rule of net interest expenditure?
That something up to some limit you can claim full, something like that. No, 1 million or something.
Okay, Mujaddid will know. Kalama, do you know safe harbor?
I don't recall.
Okay, then Mujaddid and Abbas are left. Anybody?
It can be only claimed up to 75% of the
No,
tax.
that's not the safe harbor rule. Abbas,
No, I can't recall myself.
12 million dirhams. Can you remember now?
Yes, yes.
So,
How many million? How many million? 12 million.
12
Up
million
to
dirham.
Up to the limit.
What happened was, Mr. Nazar, that initially the decree law only contained 30% of the EBITDA, no explanation, right? Later on, when that decision came, which clarified that this EBITDA means tax EBITDA, and 30% of the tax EBITDA is the maximum amount you can claim. At the same time, one more very beneficial rule came, and that rule was that if your net interest expenditure is up to 12 million dirhams, then this 30% tax EBITDA rule does not apply. You can claim entire tax expenditure, entire net interest deduction limitation. No need for calculating 30%.
Up to
Okay,
12 million. Huh?
up
Okay.
to 12 million. If the net interest expenditure is beyond 12 million, then the 30% tax EBITDA rule will apply. Clear? Okay. Any questions or points here? You guys should refer to the decision containing interest deduction limitation rules. Okay, that decision is available on the Ministry of Finance website as well as FTA website. So, anyways, going to the next point, artificial separation of business. Uh, let us look at it. Actually, it was addressed in a decision as well. In this section, you will look at artificial separation of business, Article 6. This is last of the small business relief rules, detailed in ministerial decision number 73 of 2023. What are those rules? One or more persons artificially separated their business or business activity in order to be able to use the small business relief. This will be, it's a tax avoidance measure, negative approach. The aggregate amount of revenue across the person's entire business activity exceeds the small business relief threshold, 3 million. One or more of the persons elected to apply the small business relief, then what will happen? It will be disallowed by FTA. Doing so would be considered by FTA to be an arrangement to obtain a corporate tax advantage under Article 50. Can somebody remember what was Article 50 of the corporate tax law? GAR, General Anti-Abuse Rules. So, tax avoidance is not allowed under UAE corporate tax law. While you stay within the limits of the law, but the intention is to artificially gain an advantage. This is called tax avoidance, and it is not allowed. When determining whether the business or business activity has been artificially separated, Ministerial Decision number 73 requires FTA to consider whether the arrangement was undertaken for a valid commercial purpose and whether the person carry on whether the person carry on substantially the same business or business activity. This is a key point here. Whether the persons carry on substantially the same business or business activity. A consideration is to be made by taking into account all relevant facts and circumstances, including but not limited to the financial, economic, and organizational links between each of the separated entities. So, we have to, we call SIGA, core income generating activities. So, we have to look at the connectivity or relationship between those newly formed two entities. There we had one company, we split it into two companies. We have to look at it. One is a trading concern, other one is service concern, and the businesses are completely unrelated. In one company we were doing accounting, other one is a data center, for example, entirely different story. Then there is economic logic available, rationale available for separating the two entities. But if it were, one was accounting, the other was tax, and we just separated it, that accounting is separate, tax is separate, a consulting firm, that will create a big question mark. That this seems to be an effort to just create two entities to stay within the 3 million threshold and avail small business relief. That will be seen as avoidance of tax.
Mr. Altaf, what if the separation was done before the tax period, or like they've done it because of any other purpose?
Okay, good question. But if you remember this GAR principle, Article 50, do you know when this GAR is applicable? When did the corporate tax law come into force? Can you please tell me? Somebody give me this answer.
2023,
What date?
um, in June.
1 June, 1st of June, correct?
Yes.
But if you really remember the decree law, you would know that the GAR principle came into effect way before that. Let me take you to Article 50. Yeah. So you should know that this GAR principle, this Article 50 that we are looking at, this became effective immediately. And this, this law was actually published in the official gazette in the month of December 2022. December 2022, and this law became active. If I read the last provision, I think it said it will be, the decree law shall be published in the official gazette and come into effect 15 days after the date of publication. From that day, like beginning January, I think 1st of January, this law became effective, Kalima. So that means GAR provisions apply even before the first day of corporate tax, 1 June. So from effectively from 1 January 2023, GAR provisions were applicable. So if people, if any company has, tried to do this artificial separation, even after immediately after the corporate tax decree law was published in the official gazette, 15 days after the publishing in the official gazette, that will still, FTA has the jurisdiction to see that. So because that will be seen as as a measure to avoid tax. But if this separation was done even before that, even before the this GAR provision came into effect from 1st of January, then it will not be addressed by FTA, because this is like before the tax period. I hope you got the answer.
Yes.
Okay, so anyways, let's go through. Article 6 of the ministerial decision is not a self-contained code to determine whether the persons have embarked on tax avoidance. This is because Article 50 must also be considered, uh, since this is article defining the corporate tax advantage. Let's look at Article 50 GAR. This is a very, very important point, aspect of the decree law. The manner in which the transaction or arrangement was entered into or carried out. When we look at the abuse of tax, we have to look at these things. The manner in which a transaction was carried out. Then the form and substance of the transaction or arrangement, meaning what was the actual intention behind the transaction or arrangement, that we have to look at. Then the timing of the transaction or arrangement, this also we look at. Timing will matter, Kalma. If something was done in January of 2023, then it is very much within the jurisdiction of FTA to look into it, because that was the time when GAR was already activated. The result of the transaction or arrangement in relation to the applicable law. I mean, you did some action. What was the consequence of that? Both entities became under the threshold of small business relief, for example. That if that was the result, then FTA will be concerned. They will look into it. Any change in the financial position of the taxable person that has resulted, will result, or may reasonably be expected to result from the transaction or arrangement. Financial position of the taxable person. Any change in the financial position of even another person that has resulted or will result or may reasonably be expected to result from the transaction or arrangement. It can be another person as well, another group entity, parent company, etc. Third party even. Whether the transaction or arrangement has created rights or obligations which would not normally be created. So is it like out of the blue or extraordinary? This is not normal. That also we have to look at. Persons dealing with each other at arm's length in respect of the relevant transaction or arrangement. If it were a transaction between related parties, we have to look at arm's length principle as well. Any other relevant circumstances. Were the FTA to apply Article 6 of the ministerial decision alone instead of Article 50 of the decree law, then the taxpayer should have reasonable grounds to support an appeal. But FTA does not leave that. They always apply Article 50, which is GAR. Now let us look at taxable income. When determining whether a freelancer should apply to the FTA to use the small business relief, it should compare the relative benefits of the small business relief rules and the rules allowing for a freelancer juridical person to claim an arm's length remuneration as a deduction and the 375k 0% rate threshold. All these matters would be seen. Should the freelancer choose not to elect the small business relief, then the taxable income would be calculated by applying the rules set out in the mother law. So normal procedures would apply. Holding companies, another very important aspect. So just to let you know, guys, I think I have already shared this before as well. Just board of holding companies. I think I've written this as well. So I'm just going to share this article with you as well, so that you can refer to it. There you go. In this, you can see some references to various, holding company implications that can fall due. So it has been addressed in detail. You guys can read that article as well. So in this section, applicability of the Decree Law 47 of 2022 is considered to be book profits of UAE juridical persons established to hold stock in trading company, hold shares in trading companies. And so what this is a very important aspect, because holding companies are exposed to a lot of angles. They in one respect they are investment companies. Why? Because they have invested their money into their subsidiaries, right? So it gets them the investment benefit. They can become qualifying free zone persons if they meet other conditions. But then again, if the subsidiaries are foreign subsidiaries, it creates a lot of other problems. The poem would come into play, double taxation would come into play. So it's a very tricky area, holding companies. Companies formed under the federal law number 32 of 2021. This is the latest version of the commercial companies law, guys. If you don't remember it, please note it down. Federal Law number 32 of 2021, latest version of the Commercial Companies Law, also called mainland companies. Companies formed in a free zone, or so-called the free zone companies. So quite a few free zones are available. They may be subject to various laws, free zone laws as well, but all of them are subject to Commercial Companies Law. Family companies. Just to let you know, now UAE has a family company law as well. I think, yeah, this is family companies. The majority of shares in a family company must be owned by persons belonging to the same family, to which the Federal Decree Law number 37 of 2022. This is the law of family companies. UAE has a special law for that. A family company can take the form of any company recognized by the federal commercial companies law, with the exception of public joint stock companies and general partnerships, or under the laws in force in the free zone. In order to make the discussion manageable on the profits, manageable, the light is shown on the liability to decree law taxation on dividends received by the holding companies. So just out of curiosity, let me ask you some one question. In your view, uh, is it necessary to set up a holding company in mainland in UAE? What are the different options available? From a practice perspective, I am asking this question. If you some client has come to you and they're saying, look, sir, we have some foreign subsidiaries also. We have one company in, for example, USA, one in India, one in Pakistan. Okay, these are our existing companies, and we want to set up a holding company structure in UAE. So, what are the choices available to us? So, how will you advise them? What are the choices available to them? In perspective of corporate tax law as well, we need to keep that option in mind as well. Come on, guys, let's hear from you. So, okay, one by one, they can set up a holding company in mainland or not? Yes or no?
Yes.
Yes. Okay. What about free zone? Can they set up a holding company in a free zone? Nobody knows?
Yes. Yes.
Any company they can form. Bhai, yes, absolutely yes. They can set up a holding company in a free zone also. What about offshore? I think Mujaddid or Abbas can answer this. Let's ask this question. Can a holding company be an offshore company? Mujaddid? No answer? Okay, let me answer you guys. Bhai, in offshore companies, you guys have to refer to the JAVZA offshore regulations, because that's the most famous offshore companies option in UAE. But offshore companies are available with other free zones as well, just to let you know. And most of those rules of offshore companies allow holding of shares, just to let you guys know. Okay. So offshore company is one option. What is the downside of offshore companies? What is the disadvantage of offshore companies? That should be an easy question.
Restriction of the business activities.
Very good. Very good. Good answer. So the offshore company cannot do business inside UAE, but they can hold shares. Okay. So there is one more activity, not a business activity, but there is one more, close to business activity that offshore companies can do. Who can tell me what that is? Come on, yaar, Mujaddid, Abbas, you guys know UAE framework. You should be answering this question. Properties, bhai, properties. Can offshore companies hold investment properties?
No.
No. Okay. They can. Answer is they can. Okay. You should go to JAVSA website. JAVSA offshore company regulations. Okay, and download this, search it and download this. Okay, I did a mistake, but let me come back to the course. I just typed it on the same page, but anyways, just to answer your question, offshore companies can hold investment properties. Okay, letting you know this. Okay, I think I have to open this training again because we were on the holding companies. Yeah, holding companies. Okay. Uh, right. So what were you look? Yeah, these options we read. We read family companies as well, and we discussed about the holding companies options. Dividends received by holding companies. That's a tricky area. Companies formed under the Federal Decree Law number 32, which is the mainland company law. Let's have a look at it. Domestic UAE to UAE dividend, resident dividend. Is it exempt or not? They are exempt. Okay, please understand that if you are receiving dividend from a UAE resident company, that dividend is exempt. Okay, being irrelevant whether the payer is a mainland or free zone company to begin with. It doesn't matter, it's a mainland company, it's a free zone company, whatever it is. If you receive a dividend, if and you are a taxable person, that dividend income will be exempt. Okay, a dividend received by a mainland company from a free zone company is exempt income. Foreign, less than 5% holding. Now, can somebody tell me what is that topic that we are looking at? In the decree law, it has been addressed as participation exemption. So, the rule is that a foreign to a UAE mainland company dividend may be taxable because a holding company of not less than 5% is required for participation exemption. There is some rules applicable to it. Maybe they have mentioned. If they have not, I will tell you. Okay, but first rule is that if if a company in UAE holds at least 5% shares in a foreign company and then receives dividend, it may be able to enjoy exemption, but other conditions apply. This exemption is called participation exemption. This is Article 23 of the Corporate Tax Decree Law, but there are some other conditions. A UAE company owning 4.5% of a French company receives a 500,000 euro dividend. This is taxable. Why? 5% condition is not met. If it were 5%, then this could have been exempt. Mujaddid, you want to say something? Okay, let's have a look at another condition. Foreign company, like shareholding in a foreign company, not less than 5%. If foreign to UAE mainland company dividend is tax free if the 5% condition is met. This provides for dividends and other profit distributions received from a participating interest in a non UAE company, juridical person, to be exempt under Article 23. Broadly, these are some conditions are applicable. First condition being 5% or greater shareholding. Okay, but taxable person has held or has the intention to hold that shareholding called participating interest for an uninterrupted period of at least 12 months. This is the first condition. Okay, in order for participation exemption to be valid, an uninterrupted holding period of 12 months is applicable. What else? participation is subject to corporate tax or any other tax imposed under the applicable legislation of the country. That other country meaning it means that the other country there should be corporate tax. Easy words. Okay, similar tax should be there. So if it is not there, so can you give me an example of a company sending dividend to a UAE holding company where there is no tax? Which country could that be? Come on guys, participation needed. BVI company, Cayman Islands company. You have a subsidiary in British Virgin Islands or Cayman Islands where there is no tax, and a company sends dividends to UAE holding company. Do you think this participation exemption will be available? No.
No.
Answer is no. It will not be available. Why? Because there is no tax in Cayman Islands or BVI. But on the other hand, if a US company sends dividends to UAE, will that be eligible for participation exemption? Yes,
Yes.
because UAE has very strong taxation. So it will be eligible. But another angle comes in. Participation is subject to corporate tax or any other tax imposed under the applicable legislation of the country in which the juridical person is resident, which tax is of similar character to UAE and is charged at a rate not less than the rate specified in Article 3 of the decree law. What was that rate? 9%. That rate has to be higher than the UAE rate or at least equal to that rate. If it is lower, then then the only thing that will be available is tax credit. Ownership interest.
Excuse me, I have a small question about Qatar.
Yeah.
In Qatar, the corporate tax rate is 10%.
Okay.
But they are giving the exemption for the local partners profit share.
Okay.
Say that yes, you need to have a 5149. Then
Hmm.
the 51 is the
Local part.
exempted. Yes, local partners share will be exempted. Then it falls under the below 9% or it's above 9%.
Okay. Good question. So let us create this scenario. The holding company is in UAE, right, Mr. Nazar? And the subsidiary is in Qatar, right? Holding company has more than 5% shares in that Qatari company. I wouldn't call it subsidiary, I will call it participation. That company's name is called participation, and this shareholding of 5% is called participating interest. Okay. Now, what you're saying is that company, the Qatari company, is sending dividends to the UAE company. So the question is whether this UAE holding company, for the purposes of UAE holding company, is that dividend which is sent by the Qatari company exempt or not? Will it enjoy exemption in UAE or not? That's your question, right? Yeah. So I see a very tricky, interesting loophole in this scenario. However, it is subject to further diligence. Why? Because if you really think about it, in Qatar, the company is partially exempt. If you think about it, the local shareholders' tax base is already enjoying exemption, right? And that profit that they are sending, uh, you know, that distribution of profits that they are sending, uh, that's the profit after tax. Profit after tax, on which tax has already been applied at the domestic level. So, for the purposes of UAE companies, it apparently this will be disregarded as to what is the situation there in Qatar. The only thing that will be considered as, because we have to go for the wordings of the law. The wording of the law is that the tax rate in that country should be, at least 9%. This type of a situation which you have just mentioned, it is behind the scene. So, uh, this may be questioned by FTA. It is quite possible that the profit distribution that is coming from that Qatari company, actually the tax rate is not 9%. You know what FTA might say? They might say that while the corporate tax rate is 10% in Qatar, but the effective tax rate we have to see. You see
Yes,
my point, Mr. Nazar?
yes, yes.
Effective tax rate is a different measure. So whatever tax that company paid in Qatar, whatever tax that company paid in Qatar will be seen on context of the total profit before tax, right? That or the yeah, total profit before tax. So, and if that is the situation, by default this tax rate has fallen below 10%. If you really think about it, if you use the weighted average method, so effectively if you really think about it, if the 49% is the expatriate shareholding, then you have to multiply this 10% with 49%. That means 4.9% tax. So if you ask me, the effective tax rate in Qatar is not 10%, it is 4.9%. You get my point? Do you agree, Mr. Nazar?
Yes,
If it is not clear, tell me, Mujaddid, do you get my point?
yes, I agree.
So this will be seen. So the wordings are a bit open ended if you really look at it. The wordings are that of a resident which tax is of a similar character to the UAE corporate tax and it's charged at a rate. They have used the word at a rate, not less than the rate specified in Article 3. A rate it does not specify that this is the rate specified in the in the legislative framework, tax framework of that country, or is it the effective tax rate? There is very high chance that FTA is going to interpret this word a rate as the effective tax rate. Okay, moving on. Ownership interest in the participation entitles the and by the way, Mr. Nazar, if that is the case, if the effective tax rate has fallen below 9%, then do you know what will happen?
They will not allow to deduct the tax paid in
In
Qatar.
in UAE, the
Yes,
participation exemption will not be available.
yes, yes, yes.
However, what will be available is the tax credit, right? Participation
Yes,
exemption is very closely interlinked with tax credit provision.
yes, it's but both are same, no? Amount wise.
No, I couldn't understand your question. Amount
No,
wise, same.
amount wise, both are same. No, the tax effect is same to the UAE client. Either you accept the creditor, you allow whatever.
No, they are not. If you, they are not the same, na. In UAE, the tax rate is 9% after the exemption threshold of 375K. But
okay.
in Qatar, the effective tax rate you can calculate even without doing anything. Why? Because we all know that the tax base of the local shareholder, which is at least 51%, is already exempted. So we can simply, we can look at the overall effective tax rate. It has fallen below 10% into that 49%. You get only 4.9% tax rate actually on the company's
Okay.
profit. So we can see already that the effective tax rate is below. That is why the
Oh,
exemption, participation exemption in UAE will not be available, but tax credit will be available.
yes, okay. Okay. You can deduct from your tax payable amount, and then it's not your exempt income for the UAE company.
Yeah, it will not be an exempt income, it will be taxable income, and you
Yes.
can claim
You
the
can deduct,
tax.
but effect is same, no, anyway, that UAE company, that no, effect is not same. Yes.
The effect is not the same. So
Not the
anyways,
same.
coming for going forward, did we read this? Yeah. This next one, not more than 50%. This is a tricky thing, but I remember that they have given a very good example for it. We'll read this anyways. Not more than 50% of the direct and indirect assets of the participation consist of ownership interests or entitlements that would not have qualified for a UAE corporate tax exemption under Article 23 if held directly by the taxable person. So that's a there are two times not available, not more than 50% that would not have been qualified. So if you remove not from both places, it becomes more than 50% of the direct and indirect assets would have qualified for UAE tax exemption if they were directly held by uh, the taxable person in the UAE. Then in that case, uh, this exemption, participation exemption, would not be available. Any other condition? We are going to this point. We are going to look at an example. It is coming ahead. A participation is deemed to satisfy 9% corporate tax precondition, where principal objective and activity of the participation is the acquisition and holding of shares or equitable interests that meet the conditions of Article 23. So this is this is an interesting scenario that the principal SIGA of the participation, that company in which we have invested shares, their business is holding of the shares and equitable interest, and income of the participation derived during the relevant tax period consists of income from participating interest. So, effectively dividend income. Example, that's what I was talking about. This example will clarify. A UAE mainland company owning 7% of a French company for more than 12 period, uninterrupted duration. Which company pays normal French corporation tax? So there is high taxation in France, very high. I think very high, 40% or something. Receives 500,000 euros of dividend. The dividend should be participation exempt. So that's an easy example. French, because there is taxation in France, you're meeting the threshold, 5% threshold, and 12-month duration is also there. You have not changed any shareholdership, or the company has not changed its core income generating activity. Then these conditions, once these conditions are met, this dividend will become an exempt dividend under Article 23, which is participation exemption. The next type of holding company you will look at is a free zone. Review the following dividends to see if they are taxable or exempt from taxation. Domestic, I think we have time and again discussed it. If you are receiving dividend from a domestic company, resident company, then it will be exempt. It's straightforward. Uh, Dividend from UAE companies are exempt. Foreign companies but less than 5%, summary is that if it is less than 5%, participation exemption tests are not met and it will be taxed in UAE. And the third category is foreign holding of shares not less than 5%. So if that is the case, then we discussed different conditions that if uninterrupted period of 12 months is there, no change in shareholding patterns, etc., and other conditions are being met, then this will be entitled to tax exemption under Article 23. Example is given: a 300,000 euro dividend received from a German company in which 10% stock is owned. So 5% threshold is met. It is. Germany has corporate tax. Yes. The higher than UAE? Absolutely yes. The dividend is exempt if it qualifies as qualifying free zone income. Otherwise, it will be non-taxable since the UAE company has owned the stock for 24 months and the German company pays German tax as at the normal German corporate tax rate. So let me show you ministerial decision number 265 as well. Ministerial decision number 265. There it is. Can you see my screen, guys? This is ministerial decision number 265 and it identifies the qualifying activities and excluded activities. Let's have a look at article 2 actually. So this is article 2 which identifies what are the qualifying activities, what are the excluded activities. The first part is qualifying activities. Okay, all of these: manufacturing, processing of goods, trading of qualifying commodities, holding of shares and other securities for investment purposes. What have we been studying up till now? Recent, all this participation, exemption, etc., etc. Right? This is actually a qualifying activity. Holding company that is holding shares or securities for investment purposes, definitely a qualifying activity, and it can make that investment company or holding company a qualifying free zone person if it meets all the conditions. Let us have a quick look at the family companies as well. Domestic. So again, UAE to UAE dividends are exempt. That's the first point. Doesn't matter whether the payer company is a mainland company or a free zone company. Again, same thing, foreign. So basically, same provisions apply to family companies as well. In short, there is no change. There is no change. Profits on sale by the holding company. Let's have a look at what happens when companies sell their shareholdings. So the Federal Decree Law number 32, Commercial Companies Law. Let's have a look at this reference. Domestic, not less than 5% holding. Profits on sale. I will summarize it in a very simple way. Uh, the taxability of whatever you studied for the dividends, exact same things apply. It should be at least 5%, uninterrupted period of 12 months should happen, no change in the core income generating activities, etc. If all of that is met, it does not matter whether it is proceeds of dividend or proceeds of gain on the shares that you were holding. Treatment of tax will still be the same. Treatment of tax will still be the same. There is no change. One example, an AED 350,000 profit was made by a UAE mainland company from the disposal of its 10% stock in a UAE mainland company. Is exempt because the stock was held continuously for 15 months and the investee was subject to UAE corporate taxation. So this is a local company, resident company. Yes, you sold the stock and made some gains, it will be exempt.
Even for the local company also that 5% is required or no?
So no, for the local company, hold on a second. It This is a special exemption. It is not participation exemption, Mr. Nauzer. So okay, for local companies, the participation exemption matter is not even applicable. Let me tell
Okay.
you, there's an article in the decree law which is for exempt income. Let's see, yeah, exempt income. Exempt income. See article 22. Can you see this? This is decree law. Okay, this is the mother law. Dividend and other distributions received from a juridical person that is a resident. You see this?
Resident law.
This first article. So, Mr. Nauzer, the point is
Yes.
that this is not participation exemption and no 5% rule applies.
Okay.
If it is a local company, if it is a resident company of UAE and you're receiving dividend from it, even if it is 1 dirham, even if your shareholding is 0.1%, it is exempt. Okay.
Okay. Foreign company can't become a resident company of UAE.
Hold on. Let's go back to your words. So you have to, as I said again, we have to be very careful in choosing our words. Your sentence was a foreign company can be a resident or not. That was your point, right?
Yes.
So you chose correct words. Foreign company can both be resident as well as non-resident. Non-resident by default, it will be non-resident because it is incorporated in another country. Foreign company, correct?
Yes. Yes.
But it can be a resident as well. When does it become a resident, Mr. Nazar?
When they have a permanent establishment in
No,
the
no,
country.
no, that's wrong. That's wrong answer.
Source income source income
No, that is also wrong.
UAE source income.
No, that is also wrong. Let me tell you when it becomes a resident. Uh, which article we are looking at? We are looking at Article 11. Sir, please, you have to refer back to these articles. Very important for you. Read this paragraph. Article 11, definition of a resident person. The one that I have highlighted. A juridical person that is incorporated, otherwise established or recognized under the applicable legislation of a foreign jurisdiction, that is effectively managed and controlled in the state, meaning UAE. Poem concept. Now you understand?
Yes.
If,
Yes.
if a
That means
foreign
yes.
if a foreign company is effectively managed and controlled in UAE, it becomes a resident company.
Resident.
Okay?
Okay, and then if you get the dividend from them, then it
Exempt.
will not fall under the 5%
It will not.
participant.
It will not because it will be a resident company. Okay?
Okay.
Okay, example. An AED 350,000 profit was made by a UAE mainland company. By the way, just to build on your point, we should not hurry that much. Let us have a revisit of the Article 22 to answer your question. Maybe there is something we should have a look at the exact wordings of Article 22. Let us read this. Dividend and other profit distributions received from a juridical person, that is, what is written, Mr. Nazar? That is a resident.
Yes.
Nothing on foreign or local. Am
Yes.
I right?
It's a resident. Okay.
That is a resident. It can be a foreign company, but it has to be a resident. And if it is a resident, then doesn't matter what is your shareholding, 5% or 1% or 0.1%. If it is a resident company, it will fall under the exempt income. Okay.
Okay.
So, anyways, an AED 350,000 profit was made by a UAE mainland company from the disposal of its 10% stock in the UAE mainland company. So, both companies are a UAE mainland company. It is exempt because the stock was held continuously for 15 months. Okay, and the investee is subject to UAE corporate tax. Did we go through this already? Domestic less than 5% holding, profits derived by a UAE juridical person from the disposal of a holding of not of less than 5% of UAE juridical person will be obviously it will be subject to tax because it is not meeting the 5% threshold, right? Example is given. A AED 350,000 profit was made by a UAE mainland company from disposal of its 3.5% stock in a UAE mainland company is not exempt because the holding percentage is less than 5%. That's a wrong example. A 350,000 profit was made by a UAE mainland company from the disposal of its 3.5% stock in UAE mainland company is not exempt because the holding percentage is less than 5%. I think there is a problem here because if it is a UAE company, the disposal on you can tax if the dividend that you are receiving was exempt. How can the shares that you are selling be gain on the sale of those shares be taxed? That's a big question mark. Foreign company not less than 5% holding. So uh, profit on again let's have a look at Article 23 here. what words are they using? Have they used the word to define participation? Let's see. A participating interest means 5% or greater ownership interest in the shares or capital of a juridical person referred to as participation for the purpose of chapter. Following conditions are met. Taxable person has held or has the intention to hold the participating interest for an uninterrupted period of 12 months. So here they have not defined the word participation, right, referred to as participation. The only place that they have mentioned the word participation, it is, let us quickly have a look at whether they have defined participation in the article 1. I don't think they have defined this in article 1. No, they have not. So that means 5% or greater ownership interest in the shares of a juridical person referred to as participation. For the participation is subject to corporate tax or any other law imposed in under the applicable legislation of the country or territory in which the juridical person is resident. So that we are talking about a non-resident company. But if it is a UAE company, then this topic was not even related to participation exemption, the last example that we saw, because this was a UAE company whose shares were being sold out. So anyways, foreign not less than 5% holding, this the summary result is that such shareholding, any gains on that will be exempt. Why? Because what we are dealing with is a foreign participation more than 5%, uninterrupted period of 12 months, you dispose it off, it is exempt. And the categories have been identified in article 23 in detail. You can mention, you see, not more than 50% of the direct indirect assets consist of ownership interest. These are the conditions. Whether, and it mentions that, whether it is dividends or other profit distributions received from the foreign participation, or gain or losses on the transfer or sale of the participation interest, all of these are exempt. So you were holding shares, you disposed and you got gains or losses, so these will be exempt. Dividend and distributive shares, they will still be exempt. Foreign exchange gains, losses, they will also be exempt. And impairment gains, it could be impairment gain, but impairment losses will also be exempt. And gains meaning probably reversal of impairment loss. All of these four categories are exempt categories for participation exemption. One example, AED 350,000 profit was made by a UAE mainland company from the disposal of its 10% stock of a French company. This example we read earlier, it's a repetition. Because the stock was held continuously for 15 months and the investee was subject to corporate tax in France. So naturally, this will be an exempt income. So if a profit was made on disposal of shares. Foreign less than 5% holdings. Profits derived by a UAE juridical person from the disposal of a holding of less than 5% in a non-UAE juridical person will be liable to UAE corporate tax. Why? Because the shareholding percentage is not being met. So it will be liable to UAE corporate tax. An AED 350,000 profit was made by a UAE mainland company from the disposal of its 3.5% stock in a British Virgin Islands company is not exempt. Why? BVI has no tax. Because the holding company percentage is less than 5%, but more importantly, there is no tax in BVI. Both conditions are not being met. Free zone persons. In the following timeline, you consider whether profits received by free zones or on disposal of stock in the investee are exempt from taxation or not. Let's have a look. Domestic, not less than 5% holding. Let's directly read the example. A UAE free zone company makes a 2.5 million dirham profit on the disposal of 25% stock holding in a second free zone company. One free zone company is making profit by disposal of shares in another free zone company. And how much amount? 25% stock. The profit is participation exempt because the stock had been continuously owned for 36 months and the investee is deemed to satisfy the subject of tax test. It's a UAE company itself, first of all. Even if it is a free zone company, it's still a UAE company, and
Yes, and then why they are referring to the participation?
that's a big question mark. But we know that although the logic that they are providing is a different logic, but uh, still we know that this is a UAE company, so the exemption will be applicable. The By the way, the wording domestic, this wording probably is not used by the Article 23. Can we look at if this article uses domestic anywhere? Nothing. This wording is used by the author themselves. So whenever you guys are ever in any confusion or vague word comes, or it is a commentary from an author, like the case that we see here, the word domestic is not a corporate tax decree law word used in Article 23. It is a word chosen by the author. Then always refer back to the article and read the article to get a clear understanding, and that will clarify. But anyways, the summary of the example, we know that both companies are UAE companies, so disposal of shares will still be exempt. Domestic less than 5% holding. Abbas, you have any comments on this?
On this one specifically?
Yeah, if there was a shareholding in a UAE company, we know that the income itself is exempt. So what do you think when we dispose of shares? Do you think that could be taxable? Do some
By income you mean the dividend income
dividend income.
was
Yes,
was exempt.
yes.
Um,
So let's do one thing.
should not be exempt, I think. But
Yeah,
okay, yeah, go on, sorry.
but let's argue on this. Kalima, what is your view? Hello, Kalima, are you there? So we can look at we can look at multiple angles. See, uh, the wordings of the Article 23 that we saw as participation exemption, we have to look at the wordings carefully. Income from a participating interest shall be exempt from corporate tax subject to the conditions of this article. First question is what? Participating interest, right? What is a participating interest? That's the first question. Okay, let's have a look at it. I mean, is this the first time that the word participating interest has come in? Let's have a look at this. Yes, it is not defined actually in in the article 1 to begin with. Okay, the first time this word comes into decree law is under article 22, received from a participating interest in a foreign juridical person. Dividends and other profit distribution received from a participating interest in a foreign juridical person specified in article 23. So here the words are written as foreign juridical person are exempt. Now, what is dividend and profit distribution? Any other income from a participant interest? Again, second category, any other income from a participating interest as specified in Article 23. This is Article 23. We have to read the Article 23 carefully. Income from a participating interest shall be exempt from corporate tax subject to conditions of this article. Participating interest means 5% or greater ownership interest in the shares of a shares or capital of a juridical person referred to as participation for the purpose of this chapter, where the following conditions are met. Taxable person has held or has intention to hold participating interest for an uninterrupted period of 12 months. That's the holding period. Participation is subject to corporate tax or any other tax imposed under the applicable legislation of the country or territory in which the juridical person is resident. Juridical person is resident. This paragraph has multiple implications. Firstly, we are talking about juridical person in another country. So that this is a foreign company. This is a foreign company, and it is also written that this company, this participation is resident of that country. But this does not preclude dual residency. It can be simultaneously resident in two countries as well. That's where double taxation comes in. Abbas, do you agree with that?
Yeah, yeah.
I mean, one company can be tax resident of two countries simultaneously as well. This is quite a possibility, which is of a similar character to corporate tax at a rate not less than the rate specified in Article 3, 9% rate. Ownership interest of the parties. So this paragraph clearly identifies that first of all we are talking about not a resident company but a foreign company, right? So if an example comes in front of our eyes where we are talking about a UAE incorporated company, do you think that will be covered under participation?
No.
Yeah, I agree. Mr. Nauzer, do you see my point here?
Yes, yes.
Here, by reading both articles, Article 22 and 23, it is clearly written a foreign jurisdiction. Two times this reference has been provided. First time it is provided in Article 22, Clause 2, foreign jurisdiction, foreign juridical person. Second time it is provided in Article 23, where it is said that applicable legislation of the country or territory in which the juridical person is resident, right? Which is of a similar character. Although it does not say which country, it does not say foreign country, it could be UAE as well, right? But if it were UAE, then this is a bit vague. This is a question mark, because ideally the intention seems to be to capture the shareholdings in foreign companies. But here, how do you interpret this, Abbas? This sentence, does it include UAE or not?
Um, if it were to include UAE, then we would not be talking about a participating, because then that income would automatically become exempt, being a UAE source, being a UAE dividend income, right?
Yeah,
So it should be excluding UAE then, should not being UAE.
apparently. So, but we all agree on one point here, that there is a gray area here, because by reading this paragraph, I cannot directly preclude UAE. To be quite honest, if you read the wordings of this, of the country or territory in which the juridical person is resident, this could be UAE, this could, it does not say, it does not exclude per se UAE, of the country or
But
territory in which the juridical person is resident, which is of a similar character to corporate tax at a rate not less than the rate specified in the UAE. So,
but
I
then
mean,
over here,
huh,
yeah, but then over here we're talking about foreign participating interests, right? Not ones in UAE, so it should automatically be exempt. The UAE one shouldn't be included then, no?
yeah, it's, in here we are not talking about here foreign. The word foreign is not written. It says participation. The foreign is written only here. Participating interest in a foreign juridical person. So, anyways, the point is, while writing the law, this should have been clarified a bit more in detail. But I think from the
But
spirit
Mr.
of,
Altaf,
yeah,
they are specifying that the foreign it is actually mentioned in Article 23, a
yeah,
foreign juridical person. So that means they are specifying, they're explaining the foreign juridical person here, right?
where is it mentioned foreign?
No, in the Article 22, they have,
Article 22, yes.
yeah, but after
But
that,
the
as
word,
specified,
uh-huh,
if you see as specified in Article 23, so they are referring to Article 23 after that.
good point, good catch. So that's where we solve the problem. Good catch. So by this we can conclude that by participating interest they are referring only to a foreign juridical person, as specified in Article 23. So this should have been written better, let's put it that way. But yes, from this wording we can conclude that otherwise, if I had to only rely on this paragraph, it would, it would be a question mark, because the word foreign is not mentioned here, only because of this Article 22, where the cross reference to Article 23 is made in a foreign juridical person. Only then we can conclude that we are talking about a foreign person. So good catch, Kalma. I think this is now that intention is very clear. By participation exemption, participating interest, or even the word participation, which has not been defined. Can you find anywhere where the word participation has been defined? Do you know how it has been defined? It has been defined indirectly. A participating interest means 5% or greater ownership interest in the shares of a capital of a juridical person, referred to as participation. So this is the only definition we will get for participation. But nonetheless, by reading all of that, one thing is clear, that participation or participating interest refers only to a foreign company, not a UAE company. Only the holding company would be a UAE company. So if there is an example which says that two UAE companies are doing a transaction, like one holding company is disposing of the shares of another UAE company, and that example is given under participation exemption, that is a wrong example. A UAE free zone company makes 2.5 million profit on the disposal of 4.5 stock holding in a second free zone company. The profit is not participation exempt because the stock holding is less than 5%. So the reference to participation exempt should not have even come, but we leave it at that. Foreign not less than 5% holding. Now we're talking about foreign not less than 5% holding. The commentary in the accordion, domestic not less than 5% holding also applies. Let's read the example. A UAE free zone company makes 2.5 million dirham profit on the disposal of 25% stock holding in a BVI. I think this we read, BVI does not have a tax. The profit is not participation exempt because even though the stock had been continuously held for 36 months, because the investee is not subject to tax. So that's the reason. There is no participation exemption available.
But then, but even if it were to be taxed at a reasonable rate, would it still not be? I think that it should still not be exempt because as the article says income from the company, right? But then this isn't really income from the company, or is it? Because what I'm thinking is that income from a company would be like dividend or interest or something along those lines. But then this isn't really income from the company per se.
Your
In
answer
a,
is
if you, sorry.
here in clause 5. The answer, why do I say the categories of inflows could be dividend, profit
Okay.
distribution. You used the word interest.
Yeah,
That is not covered.
that is not covered.
That is
Okay.
not covered. But
Okay.
dividends covered, gains or losses on the transfer or sale of the shares covered,
Okay.
foreign exchange gains or losses in relation to participating interest, meaning shareholding, covered, impairment gains or losses for the investment in subsidiary that we see in our balance sheet, right? Or
Yeah.
associates, investment in
Yes.
associates or subsidiaries or whatever, or generally just investments, that is also covered. But interest, that is not covered. Okay,
Okay.
because that interest is not your investment, it's a different thing, it's loan,
Okay.
basically lending.
Yeah. Okay.
What about our royalties we are receiving from
Obviously, is that investment, Mr. Nauzar?
can be some investment of your skills,
No,
no?
can you define it? No, no. What we are talking about is the balance sheet, sir. See, in the balance sheet, you see the word investment. That is paying
Okay.
of the money into another company, share capital, basically. It
Okay,
can,
okay,
it,
you are getting from your
yes,
assets, generating from
yes,
your
yes, yes, yes.
tangible assets.
Tangible, or it's debatable whether an investment is a tangible asset because it is all on piece of paper. But yes, I mean the overall company we are talking about. So the ownership interest in that company, that is investment, right? So all that royalty, etc., those things will not be seen as investment. because that's not shareholding. It involves shares basically. One word, keyword, shares. There will be either a shareholding or controlling interest, or at least actually controlling interest will also not be applicable because we're talking about 5%. So it will be shares only.
Okay, okay. Even if you give a loan to the foreign company and you are getting the interest also, will not come under this.
It will not come. It will not come. That's interest. That's lending. That's not investment. That's lending. Okay. So, anyways, family company, similar treatment applies. This is all like repetition of this. I'm going to skip this. Exact same things, repeated again and again. Ministry of Finance. At the date of writing, the Ministry of Finance website contains some helpful information on how it sees the dividend and profits being taxed. So there is a frequently asked question number 89 on Ministry of Finance website, establishes that there can be instances where a UAE business makes a strategic investment in another company and that the investment does not result in a 5% or greater ownership interest, or the percentage ownership in the partnership falls below 5%. Mr. Nauzer, think about Apple or Amazon or Google. They are huge companies, right?
Hmm.
Apple market cap is $3 trillion, right? Can you imagine 5% investment in Apple shares? How big
Yes,
will it be?
no.
Huh?
Yes, yes.
That will still be like billions, right? So, do you really think like companies in UAE could make five? They can, but how often would that be? Extremely rare. Probably none of them has that kind of an investment. So that is why later on another threshold came, and that threshold was given by another decision which said that even if your 5% threshold is not being met, okay, but you have invested 4 million dirhams. I don't know if it is written. Yeah, it is written here. This one. Okay. If you have invested up to 4 million dirhams, then this 5% threshold will not be considered. It will be seen as met. Is this point clear to you guys?
Yes.
Otherwise,
Yeah,
investing
yes.
5% in those huge companies whose market cap is in trillions of dollars would be an impossibility. It will be practically not possible. So a realistic measure was given by Ministry of Finance that if a company has invested up to 4 million dirhams, at least 4 million dirhams, then it will be seen as if that 5% threshold is met. We are not going to calculate actually. We are going to just ignore it. We'll say no, no, okay, they have done the enough investment to be considered for participation exemption. Okay. It is noted that the Luxembourg law contains a provision in relation to dividends being participation exempt when the acquisition price is not less than 1.2 million euros. Even if the holding percentage is breached, while for capital gains the acquisition price must exceed 6 million when the holding percentage is not met. So like what they are saying is this 4% rule, this 4 million rule is not new. Similar provision is applicable, is available in the Luxembourg law as well. Okay. Example. Were the UAE to introduce a minimum acquisition price of say 83 million as an alternative to the 5% holding for dividend purposes, then a 250,000 dividend on a 3% holding, which cost the UAE company 3.2 million to purchase, and which stock had been held for more than 12 months, would be participation exempt. It's an if and then scenario that UAE can introduce 3 million as well instead of 4 million. So if it is 3 million dirham and other conditions are met, then participation exemption would be available. So it's an if and then scenario. Were the UAE to introduce a minimum acquisition price of say 6 million as an alternative to the 5% sharehold, holding threshold, then a 200,000 profit on the disposal of a 4.5% holding in a British company which cost 6.5 million would be participation exempt. So it all depends on this alternative threshold. What is that threshold? Okay, we are coming to another. You remember pension funds? What can somebody quickly tell me? What was the treatment for pension funds in UAE corporate tax? Can you recall anyone?
Exempt income.
Again, income. Sir, choose your words.
Exempt business. Yes.
No, person.
Exempt person. Yes.
Yes, the words matter, sir. In corporate tax,
Okay.
words matter. So you can't say exempt income or exempt business, exempt person. This is Article 4. Okay. The taxable income of a public pension or social security fund or a private pension or social security fund that is subject to UAE competent authorities regulatory oversight and providing the fund meets that all other conditions prescribed by the minister should not be liable to corporate tax. This exemption follows from the fund being a person under Article 4.1G. This is 4.1G, that specific exemptions for the corporate tax law. Ministerial decision number 115 of 2023 on private pension fund and private social security funds for the purpose of federal decree law. They have detailed. They have given more details. Let's quickly read the example. ABC Limited formed a private pension fund, ABC pension plan, at ADGM Abu Dhabi Global Market in 2023 for the purpose of collecting from ABC annual end of service premiums for each year, and with the objective of making a payment to an employee when that person ceased employment. Providing ADGM regulates the pension fund and subject to ABC pension plans satisfying any conditions set out by the Minister of Finance basic, the ABC pension plans income and gains should be free from corporate tax. The fund itself would become exempt. Pension fund concept. Private pension fund constitute a relatively new concept in the UAE in October 22, and by way of an example, the national newspaper described the national bonds golden pension fund, golden pension scheme. So National Bonds is a very well known organization in UAE which issues bonds basically. So they have issued a golden pension scheme as well. This scheme is marketed as being a Sharia compliant savings and investment company owned by the Investment Corporation of Dubai, which began marketing a golden pension scheme intended to help private sector foreign employees invest their end of service benefits. The national advised that national bonds was to invest employees end of service benefits in monetary markets such as deposits with banks, sukuks, and in the company's income generating real estate portfolio. So what does a pension fund actually do? It takes in the money for the retirement benefits and then it invests into profitable securities. The National wrote that the pension plan was expected to help employees in the UAE bridge the retirement savings gap as well as support employees. So if this fund is being, if it has an oversight by a proper regulator, such as central bank, or for that matter, if it is in ADGM, if ADGM regulates it, then the fund itself would qualify for exemption under Article 4. It also wrote the companies can register for this scheme by either investing their employees end of services benefit accumulated over the years as a lump sum, or invest a portion of it. Employees have the flexibility to also contribute to the pension scheme. So as little as 100 dirhams as well a month. So this is one example of a public pension fund. Now, trusts, you should know that I had the opportunity to actually read the trust law of UAE, and very interestingly, and I was reading the text, the mainland trust law. Now, forget about the DIFC ADGM. I was reading the mainland trust law, and I read a very interesting angle on it, and that angle was that the you know trusts have a separate legal entity here in the mainland of UAE. Let me see if I can show you. Yeah, trust law of UAE. Yes. So this is the trust law of UAE. The interesting part is that this, any trust legal personality. See Article 3. The trust shall acquire the legal personality as of the initial registration date. Can you see this sentence, guys? This is the mainland trust law of UAE. Trusts formed under this law, the trust law of UAE, they gain a legal personality. What does that mean? If you are about to register a trust, then it will not be seen. Otherwise, what are trusts? They don't have a legal personality. They are seen as partnerships. But here in UAE, trust gets a legal personality. Okay. So four forms of trust existing in the UAE and analyze the options. Okay, different types of trust. First one, waqf. A trust was originally established in the UAE as a special vehicle, a waqf, which was used by natural persons following the Islam faith to provide for the zakat. A waqf is an inalienable charitable endowment under the Islamic law and typically involves donating a building, plot of land, other assets of Muslim religious or charitable purposes with no intention of reclaiming the assets. So Waqf is a kind of a trust where mosques or other heritage or religious value assets are controlled and managed. A charitable trust may hold the donated assets. The person making the dedication is known as the Waqif donor. Now we are going to come to DIFC and ADGM trust. Interesting, huh? The common law form of a trust was introduced in the UAE in 2005, firstly in the DIFC and subsequently in ADGM to provide for the holding and growth of wealth in the UAE. UAE, anything? Someone saying something? No. The UAE legislation providing for the establishment of the ADGM and DIFC trusts is there are these two laws. Law number 4 of 2013 concerning Abu Dhabi Global Market and the Trust Special Provisions Regulation 2016 and Trust Law of DIFC Law number 4 of 2018 together with DIFC Laws Amendment Law number 2 of 2022. So if you go to these laws and download, you will be able to quickly identify whether trust has a separate juridical personality or not. Mainland law I just showed you is intended to preserve the original fabric of the trust in Islamic countries as a tool for the charity. The let me see the number, decree law number 19 of 2020. I think this is the same. Acha, this is a latest one. This is decree law number 31 of 2023. So this is a newer law. The decree law provides also for a trust in whole or in part being set up for a charitable purpose or being transformed into a charity fund upon the occurrence of the event. So what I showed you was even more up to date. Okay.
So that
Decree.
we can form, excuse me, we can form trust only for the only for the charitable purpose, not for the business.
Uh, I would not say that, but let's look at the mother law of trust in UAE. This is the mother law of trust right now, right? So, if we let us have a look at it. The provisions of the law apply to every trust created in accordance with the provisions. Trust shall be subject to provisions of the trust instrument, but purposes. Uh, you see under the UE law, the trust is formed to gain property. Properties. So it doesn't specify charitable purpose anywhere in this. It can be charitable, but there's mention of dividends as well. Trust property, dividend. So property can be any property. It does not mean only tangible property. Okay, trust property. Uh,
That means you can run a business also using a trust
yes, yes, yes,
format.
yes. You can run a business through the trust as well. Okay. So anyway, to determine whether there is a liability to corporate tax on a trust profit, it is necessary to identify the nature of a trust. If a trust is in unincorporated partnership, then the partners are taxed in the hands of the partner. But we just saw that trust gains a separate personality. So In this particular case, trust will be taxed at entity level itself, not in the hands of the partner. Okay. But if the trust is a company, as is the case right now that we saw, then the company is taxed, and if a trust is a foundation, then the foundation is taxed. By the way, foundation is also a legal person, in case someone did not know. Is taxed unless the foundation elects to be taxed as if it were an unincorporated partnership. So there is a provision, but please remember that the wording used in the corporate tax decree law is for family foundation. Most probably we are going to read it going forward. Family foundation is going to come up later. Defines partnership to mean the person or more, such as partnership or trust or any other similar association of persons in accordance with the applicable legislation. So, partnership can include trust as well. The meaning can include trust as well. But we just saw that trust can gain a legal personality. The relevant legislation, okay, the decree law number 47 defines an unincorporated partnership. This, you remember, unincorporated partnership default treatment, the income is taxed in the hands of the partners, right? Unincorporated partnership. To be a relationship established by contract between two persons or more, such as partnership or a trust or any other similar association of persons, in accordance with the applicable legislation. Foundations and certain types of trusts are independent juridical persons with separate legal personality and would therefore prima facie be subject to UAE corporate tax in their own right. However, these types of family foundations can apply to be treated as transparent, unincorporated partnerships. So, family foundations, if it does not give it, I will show it to you directly in the corporate tax decree law. uh, for the UAE corporate tax purposes, resulting in founder or settler and the beneficiary of the trust to remain to be seen as owners of the assets. Meaning, what they are saying is, family foundations can opt to be taxed as unincorporated partnerships, where the FTA will disregard the structure of family foundation and directly tax the beneficiaries or settlers in when the income of the beneficiaries or settlers coming from that family foundation in the hands of those beneficiaries or settlers. Uh, a quick question: can somebody remember, reproduce or the provisions that we read regarding unincorporated partnerships? Simple, 1 or 2 points. Anybody?
Yes.
How do you tax
Uh,
unincorporated partnerships in UAE?
Individual partners, income of individual partners.
That is the default treatment, correct? What is the exception?
You can be you can apply for the FTA to get the, the elected to the taxable person.
For what? For the unincorporated partnership?
Yes, yes. You can
Correct.
get the election to the,
Yeah, you can elect to be taxed at entity level basically by applying to the
yes.
FTA. So,
If they elected, then partners, what will happen to the like distribution to the partners? Then again, partners also have to do the returns.
so
Return.
no. So double taxation will not happen. If just like a company, they will be taxed like a company. Think of it this way. When you tax a company, when you prepare a corporate tax return for a company, do you prepare the separate return for the shareholders?
No need, no?
No need. Same thing will happen.
Okay. Okay.
Uh, having regard to the definitions contained in the decree law and the UAE legislation covering trust, it is believed the better view is that a DIFC trust, a DGM trust, and also mainland trust would be, for the decree law corporation tax purposes, a partnership, and it follows each would be an unincorporated partnership. So the conclusion of this paragraph is that by default, trust would be seen as unincorporated partnerships. I don't disagree with this, but please understand that uh, in all the three cases that this paragraph has mentioned, unfortunately, now we have crystal clear laws available. In DIFC ADGM, it was clear from day one that trusts formed in DIFC and ADGM take a legal personality. But now in 2023, the latest trust law that came, now that trust law has also given a legal personality to trusts formed in mainland UAE. So that's where this sentence that these will be seen as unincorporated partnerships, that will become void. This will not apply. Now they will not be seen as unincorporated partnerships. They will be taxed at entity level. Below is a discussion of likely corporate tax implications. So this is a bit, in some areas of this text of ACCA, I think updating is needed. Below is a discussion of likely corporate tax implications in cases where the trust is treated as transparent vehicle. Let us have a look at it. Unincorporated partnerships not electing corporate tax status. An unincorporated partnership, and as prescribed in Article 16, the partners would be required to pay corporate tax in their on their shares of the partnership income, meaning it will be taxed in their hand. So it will be flow through taxation for the unincorporated partnerships. Complicating matters not covered in this summary include the methodology to be adopted to allocate the income between the beneficiary and, if necessary, the settlor and the protector, especially in the circumstances in which the trust does not confer fixed interest on the beneficiaries. Because trust law requires, beneficiaries and settlers. So there will be a question: how do we allocate income? So that is a detailed matter, and it will be dealt with on subject to on case to case basis. And in the circumstances in which the partner is a natural person, then corporate tax will be charged on that person, providing the partnership carried on a business or a business activity. So natural person, why this sentence? Because under the UAE corporate tax law, Mr. Nozer, you remember natural persons are also subject to corporate tax.
Yes.
Yes, if they are conducting a business or business activity, they are subject to corporate tax. If neither a business nor business activity had been carried on by the trust, then the natural person would not likely be liable to corporate tax. It therefore follows that income which should be exempt to the partnership, including but not limited to qualifying dividends from UAE companies and qualifying gains on the disposal of stock in a not less than 5% holding in a UAE or non-UAE company, should also be free from decree law corporation tax. So, same rules of exemption for resident dividend or participation exemption dividend, participation exempt dividend, they will apply in the hands of the partners also. Should also be free from decree law corporate tax in the hands of the partners. So one example: assume a DIFC trust owned stock in UAE and non-UAE companies, and also owned UAE real estate, all held by one or more UAE mainland or free zone companies. So the trust's sole income would be dividends, because it is holding shares basically, right? Stock in the UAE companies, the only income will be dividend paid by the UAE companies or profits arising on disposal of one or more of those companies. In these circumstances, the dividends received by the trust, treated as an unincorporated partnership, not having elected that taxable at entity level status, should be free from UAE corporate tax, because they are essentially resident dividend. And in case non UAE companies, other conditions for participation exemption conditions apply. Profit on sale would be free from tax if participation exemption applied. So what about those unincorporated partnerships which have elected to be taxed at entity level, caused by the complication arising in the allocating the trust income between the beneficiaries and, if necessary, the settlor and the protector? especially in the circumstances in which the trust does not confer fixed interest on the beneficiaries. Sometimes trust is formed in that manner that fixed interests are not visible. That how much belongs to which beneficiary. It is not clearly provided. What happens in that case? The partners may choose to apply to FTA to treat the trust as a corporation for trust purposes. So yeah, exactly. So that trust will become a taxable person itself. Were the FTA to approve the application under Article 16, then the look through or flow through status or transparent status of the partnership will not become relevant. The tax position of the partnership would then be determined by whether the partnership was a free zone partnership or a mainland partnership, and on whether the income derived was exempt or participation exempt. So these things will come into play. It will be taxed as a corporation. One example: assume the same fact pattern as in the immediately preceding example, but in this instance the trust elected corporation status. In these circumstances, the dividends received by the trust treated as corporation for tax purposes, meaning trust applied to FTA that please tax us at entity level, should be free from UAE corporation tax. Why? Profits on because it was being received from a local company, and if it was received from foreign companies, then participation exemption would be evaluated to see whether it applies or not. Same conditions: 5% or 4 million dirhams, 12 months uninterrupted period, etc. Waqf, this is a religious trust. Waqf is treated differently from other forms of trust because it is not formed under the UAE legislation but is formed under Islam. As such, it is anticipated that a waqf should be exempt from taxation as Article 9 qualifying public benefit entity. Yes. Anyone saying something, Abbas? Okay, so the question was like, what is this waqf? How will we tax it? So you should remember that under Article 4, specifically exempt persons. There, it's not only private, public-private pension fund or extractive, non-extractive business and this and that. There is also qualifying public benefit entity. So this waqf could be seen as qualifying public benefit entity, but there are conditions that it should be listed in a cabinet decision, for example. This is likely to be the position since the waqf would be established and operated exclusively for religious or charitable purposes, would not conduct a business or business activity except for such activities directly relating to or aimed at fulfilling the purpose for which the entity was established. So basically religious and charitable purposes. Would have its income or assets being used exclusively in the furtherance of the main purpose or mandate for which it was established, would ensure that no part of its income or assets would be payable to or or otherwise available for the personal benefit of any shareholder, member, trustee or founder or settler. These are the conditions of the qualifying public benefit entity. Now, one of the most popular forms of trust is REITs, real estate investment trusts, purely business. In this section, you will learn about the impact of decree law on REITs. Basically, a REIT is a collective investment entity formed to own real property and to distribute not less than 80% of the audited profit to the REIT members. 80%. So, where are the REITs formed usually? A REIT may be established in DIFC or in ADGM, and the form the REIT entity takes can be an investment company, investment partnership, or of an investment trust. An investment company can also take the form of a protected cell company. In DIFC, but all of these are companies basically. In the DIFC, an investment partnership is a limited partnership established for the main purpose of collective investment. Again, limited partnership means this is it. It's a corporate. It has taken the form of a body corporate, which is formed and registered under the limited partnership law and may be formed by two or more persons upon the terms with the rights and powers and subject to the conditions limitations that is provided for in the deed. So it is still a body corporate. I can't call it a company, but it is a body corporate, a separate legal entity. A DIFC investment trust is created by a trust deed entered into between a person who meets the requirements to be a fund manager under Article 20, Clause 1, A or B, Paragraph A or B of the DIFC's Collective Investment Law number 2010. Guys, just to let you know, there is a lot of discussion in the Model Tax Convention of OECD on collective investment vehicles, CIVs. Okay, and around the world, in many jurisdictions of the world, collective investment vehicles are seen as flow through entities and they are not taxed at entity level unless they take the form of a corporation. So DIFC's collective investment law, which is subject to rules made for the purpose of the law and a person who meets the requirements to be a trustee under the law. So they have simply mentioned that which law deals with these collective investment schemes or programs. We can refer to this law to find out whether the trust is a legal person or not. Whether a REIT established as an investment company, investment partnership, or investment fund is a qualifying investment fund. That's another very, very important area. Why? Because this is also a type of person, Mr. Nozer, not business income, type of person that has been given specific exemption under Article 4 of the decree law. So many different categories were there in Article 4, right? Qualifying public benefit entity was there, but there was also qualifying investment fund as defined under Article 1 of the decree law. A properly structured qualifying investment fund can be free from the corporate tax as considered further below. It is an entity whose principal activity is the issuing of investment interest to raise funds or pool investor funds or to establish a joint investment fund with the aim of enabling the holder of such an investment interest to benefit from the profits or gains from the entity's acquisition, holding, management or disposal of investment. So this is what a qualifying investment fund does. But why the word qualifying? It has its own requirements. Let's read this question. Ministry of Finance has published it on its website. Frequently asked question number 54. Ministry of Finance wrote that investment funds are commonly organized as limited partnerships as opposed to corporate entities to ensure tax neutrality for their investors. This tax neutrality follows from the fact that most countries treat limited partnerships as transparent, flow through entities for domestic and international tax purposes, which puts investors in the funds in a similar tax position as if they had invested directly in the underlying assets. So basically the idea is that although there is a fund which is investing in different securities on behalf of the investors, but when it is being taxed, it will be seen as if the investor will be taxed for the income that it receives. And if it is a passive investment, it goes out of the scope of the corporate tax. Investment funds that are structured as partnerships, unit trusts, or other unincorporated vehicles would generally be treated as unincorporated partnership. This is very right, and it is a very important sentence for us to remember. Okay, sometimes what happens is in DIFC we have seen many cases where an investment company creates a fund, maybe a mutual fund, maybe an investment fund, and it manages that fund, and they sometimes have discretionary powers. So there are particular types of licenses that are provided. the article that I shared with you guys, it contains the different categories of licenses that DIFC issues. Some are discretionary powers, where the fund manager has the power without asking the investor where to invest. But there are non-discretionary as well. So there, the investment manager has to ask the investor, take permission from them. So, but in either case, if it is only a fund that was originally formed by an investment company, then that fund will be seen as an unincorporated partnership, because that fund does not have a separate legal entity of its own. Investment funds that are structured as corporate entities, yes, there is possibility to create a dedicated investment fund by way of forming a corporate entity. And sometimes real estate investment trusts are formed by way of corporate entities or partnership funds that apply to be treated as taxable person for the UAE corporate tax purpose in their own right can apply to the FTA. So what we gather from this paragraph is, whether, okay, fine, we formed a real estate investment trust, or for that matter, any investment fund, uh, and it did not have a legal entity. It can still go to FTA and request that please tax us at entity level, treat us as a corporation. But if on the other side, if that investment fund was formed as a legal entity, then by default the law will apply and it will be taxed as a legal entity. Cabinet Decision 81 of 2023 on conditions for qualifying investment funds for the purpose of this decree law has provided detailed conditions for that fund. Generally speaking, those funds have to be managed. There should be public oversight, etc. Article 10. I think Article 10 is for qualifying investment funds. So they have given a summary of it. Let us quickly go through. Investment fund or investment funds manager is subject to regulatory oversight. I mentioned this earlier, by a competent authority or a foreign competent authority for the regulation purposes. The answer to the question is fact specific, but a REIT should be expected to be regulated. REIT is generally regulated in UAE. It is usually regulated. The Ministry of Finance frequently asked question prescribes that for the investment fund exemption, either the investment fund or the manager of the fund is required to be subject to regulatory oversight, not both. Interests in the funds are traded on a recognized stock exchange. So that's or are marketed and made available sufficiently widely to investors. OTC, over the counter. So you can investments targeted securities will either be traded already on a stock exchange, recognized stock exchange, or they will be, for example, available with banks or other financial institutions. You can go there and buy it on the counter, OTC. The answer to this question is fact specific, but a REIT should be expected to be traded on a recognized stock exchange. The main or principal purpose of the investment fund is not to avoid corporate tax. Why? Because sometimes there can be an arrangement that let us form a fund, because then we'll be creating a further layer. If the main purpose of the REIT is to purchase real property which is then held for rental purposes, then it seems unlikely that the main purpose would be that of avoiding corporate tax. Uh, there is one more important. See, it is when they say that it is unlikely, it is a very important aspect. You guys remember that there is business income and then there is passive income of the natural persons, right? If the natural persons owned investment property directly, do you think those rentals would be taxable? Under the UAE corporate tax law, they will not be taxable. They will not be taxable. So, if that is the case, that the investor directly holds the property and they are not taxable, then why would those be taxable if a REIT holds those? And especially REITs are, we know that we read that REITs default treatment is at all, by default it is an unincorporated partnership. So, generally speaking, it would not be subject to corporate tax. any other condition as may be prescribed in a decision issued by the cabinet at the suggestion of the minister. And there is a decision, cabinet decision number 81 on conditions for qualifying investment fund. For you guys to remember, even if you don't want to spend a lot of time, regulatory oversight is there, trading on the stock exchange is there, wide availability is there, OTC basis, etc. So if these conditions are met, that person would be exempt. It will be seen as a qualifying investment fund. All information required by FTA has been provided within the timelines prescribed. There is another question on Ministry of Finance website. Prescribes that a wholly owned UAE investment holding companies and other special purpose vehicles used by the investment fund to deploy capital and hold investments can apply to the FTA to benefit from the exemption. So basically this is not a by default exemption. You have to actually apply for it. Okay, knowledge check. Let's do this. Select the correct answer to complete the sentence. A foreign financial institution's UAE branch may also be liable to an emirate level tax on the profits of that branch, but those taxes are levied at the emirate level. Abbas, Mujaddid, Kalma, Mr. Nazar. Foreign financial institutions UAE branch will be liable to emirate level tax, but that tax will be at emirate level, right? Okay, second question. Guys, this is the last module, so let us participate before closing it. Select the correct answer to complete the statement. Article 3(1)(a), remember this? Regime, default regime, establishes the rates to be 0% on the first. That's the easiest question up till now. That on the first
75.
375,000 dirhams. Select the correct answer. What is accounting method based on measuring the value of the assets using the current prices and assets or liabilities? Kalma, you should be able to give this answer. The value can change over time. Impairment and fair value method, accrual, value based, mark to market.
Value based.
No, impairment and fair value. You forgot we have done this in the conceptual framework. So impairment and fair value. So that should be the answer. Okay, true or false? The deductions available to a financial institutions are expenses shown in the taxable person's income statement as adjusted. Easy. True or false? Come on, guys. Simple question. Deductions available to a financial institution, or for that matter, any other company, are the expenses shown in the taxable person's income statement as adjusted.
Yes,
So it is
true.
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 Next. This is a tricky one. Select all that apply. IAS 36 applies to financial assets classified as assets as defined in IFRS 5 non-current assets held for sale and discontinued operation. Is it applicable? I know that IFRS 10
No.
applies. It will not be applicable. Investment associates will be applicable. Impairment of other financial assets is covered in IFRS 9. Other financial assets, is it?
Yes, it's false.
This is false, or shall I
It's true.
select? It's true.
We should select this.
And what about this? Joint ventures as defined in IFRS 11? Joint arrangements? I mean, I don't remember it, but because it seems similar, like joint ventures. I mean, two entities, and we recognize our share of the joint venture. And if it is impaired, it is impaired. But is it? But whether the impairment is covered in IF 36 or not? No, I don't think this. But okay, And well, let's just go. Maybe if it is wrong, it is wrong. We'll see. Incorrect. So which one was not applicable? This IFRS IS certificate applies to financial assets classified as subsidiaries. Yes. Which one did we do? This one. This we should not have selected. Okay. Let's see the question number 6. Select the correct answer to complete the statement. If the pension fund is exempt, the periodic income and profits of dash will not be liable to UAE corporate tax, uh, providing the pension fund satisfies the regular. So what was that? If the pension fund is exempt, then the periodic income and profits of the investments, I think, will not be liable to UAE corporate tax, providing that the pension fund satisfies the regulators' conditions and those to be published by the minister, if any. What should we say? Pension fund does not involve into business activity, right? It will invest only. Uh, so let's click the investment and see. Incorrect.
Ah,
If the if the pension fund is exempt, then the periodic income and profits of assets disposal will not be liable to UAE corporate tax. Okay, fine. Number 7, let's see. What is an inalienable charitable endowment under Islamic law? Waqf, it should be waqf. And typically involves donating a building, a plot of land, other assets for Muslim religious or charitable purposes. I think it is waqf, right?
well,
Okay. And then what is that? What is 8? The applicability of the decree law is considered to book profits of UAE juridical persons established to hold stock in trading companies, and for this purpose the juridical person considered are applicability of decree law is considered to book profits of the UAE juridical persons established holding companies, right? So to hold stock in trading companies, and for this purposes the hold stock in the trading companies. So we're talking about holding up, and for this purpose the juridical persons considered are mainland companies, yes. Free zone companies, yes. Family
family.
companies, yes. What about trusts? That's a natural person will not be there, but
Yes,
trusts
that's also.
trust also should come here. The applicable to the clause book or juridical person established to hold stock in trading company. Yes, trust should come. Bismillah. Let's see. Trust did
No,
not come. You know why they did not take trust? Our answer is correct. But the reason they did not take trust is because trust they do not think as a corporation. But we have seen that the latest law that has come into play uh,
As
in
a legal
it
personality.
has is a legal personality. So, anyways, true or false? Non-resident individuals and non-resident companies can claim the small business relief. Of course not. Non-resident cannot, right?
false.
False. That's an easy one. Okay. Last one. Select the answers to complete the statement. A REIT is a collective investment entity formed to own real property and to distribute not less than, I believe it was 80%, right? 80% of the audited profit to the REIT members. 80%. Okay. Let's see. Correct. Okay. That completes.
Yeah, Benty.
Barely passed, huh? Okay, great. Uh, Thank you very much, gentlemen and ladies. So today we completed all the three, review the implication of special entities, principles, and so that completes your course. That's why there is no further. Uh, Let us stay in contact. You guys, I think you people have already received the MCQs for the first 4 modules, I believe. More I will be providing, inshallah. So, if any one of you wishes to take this exam with ACCA and UAE, British Council, Exam Center, etc. All guidance is provided here. Perhaps I will download this and share with you guys. Let me know if you guys require help in that sense. So it was great having you on this course, and do stay in contact. Okay, I'll be available to respond to your questions. Thank you very much, everyone. Any feedback? No feedback? Okay, great. Perfect. Thank you, guys. Thank you for attending the course. Take care. Assalamu alaikum.
Thank you so much. Thank you.